What's going on, family? How's it going? How's it going? Good evening, everyone. Welcome, welcome, welcome. So I'd like to start out by telling everyone welcome to my platform. My name is Simsia, and today we are going to discuss what we should do. What we should do. Should we go ahead and sell our positions in the market, or should we go ahead and dollar cost average our way into better position? So today we'll be having a panel discussion with a few gentlemen where we'll be discussing this topic. This is something it's been relatively newer to me. It's something that I really did not understand until I became involved in the personal finance space and did not really understand the benefits of dollar cost averaging or timing the market. So the goal today is to have an opportunity to have a discussion, a healthy discussion that would allow us to weigh the odds of choosing between wait until we hit the bottom of the market or taking advantage of the opportunity for us to dollar cost average our way into a better position. So what I'd like to do is I'd like to introduce a few panel members who will be joining us here where we'll be having this discussion. These gentlemen come from a variety of different backgrounds, and what they'll do is they'll give us perspective from their standpoint as investors as to what they would do given this current situation that we have in the market. So the first gentleman I'm bringing up, his name is PerryUnlikely. He has a YouTube channel, and on his YouTube channel, he shares various different investing concepts that I believe are very valuable to us. One thing about PerryUnlikely that I admire is that he comes from a family background, so a lot of his beliefs are rooted in the idea of building generational wealth or having something substantial for his family. But what I admire second is that he's giving you real world perspective about how to evaluate the opportunities that are here before us. So I'll let him go ahead and share a little bit about himself, but and give you guys an opportunity to understand who he is and see some of the things that he brings to the table. So welcome, Perry.
Hey, I appreciate it, man. Appreciate it. Glad to be on here, man. My main focus on YouTube has been cryptocurrency, just because really it's the opportunity. I started investing in it slowly. I've been in real estate and real estate investing, but as I started putting money in crypto, and honestly, up to this point, it's the quickest money I've made in terms of substantial numbers, probably the fastest ever. Now, that doesn't mean it's not volatile and it's not easy to navigate, but just being able to make that type of money, I really started digging in more. Obviously started posting videos. I think I've got roughly 170 videos, somewhere around there, over 170 videos on cryptocurrency and, the opportunities. And like Sim said, I'm definitely family oriented. So it really is about legacy, but it's not, a lot of people say, leaving my children something. It is that, but it's also getting them to a point where they wouldn't even need me to leave them something. I mean, I will, but it's very important that I get them to a point where, they're in real estate, they're investing, and they're just able to, entrepreneurs able to pave their own path, but also that they have the education as well to go out and make money, because I still believe working for someone else, there's a far greater chance of building wealth that way and then investing than any other way. So yeah, definitely happy to be here and have the conversation tonight.
The next gentleman we're bringing up, appreciate you, PerryUnlikely.
Absolutely.
So subscribe to his channel. He has some amazing content. He's engrossed into the crypto space, and I feel like the information that he's able to glean, the information that we're able to glean from his channel is very valuable. And I strongly encourage you to check out his channel and really give it some thought and have an opportunity. You have an opportunity to really see see things happening on his channel way before the community, the better part of the community, is really having a conversation. So let's uh, uh let's do that. So the second gentleman we're bringing up is to the channel is Wealth Engineering. So Wealth Engineering also has a crypto channel, and on his channel, he's sharing value added content, everything from understanding the historical components of how money works and the global impacts of how money impacts our lives here locally, and also, like I said, the global implications of all the decisions that are happening here in America. So he has very valuable information, and he's also one of the crypto guys, and I think that he has valuable information that you you could benefit from subscribing to and listening to, and you can you can really see from his standpoint how he went about putting himself in the position that he's in. And so I'm not going to take away from his channel, but I'll let him go ahead and introduce a little bit about himself.
Hey, thank you. Thank you for this intro. My name is JC from Wealth Engineering. And so basically, I started with a background in electrical engineering. And I was always trying to make money. I studied engineering because I thought that's how you can make money. That's what my mom told me. And little did I know that at some point I saw my salary was increasing, but I noticed my purchase power was decreasing. And back in the days, I wasn't really financially educated, so I was measuring my purchase power in terms of how many cars can I get. And but it could even with that, I wasn't getting the car that I wanted despite my salary increasing. And I was like, something's wrong. Something's wrong about this. It's not actually meeting the expectation that I was getting at. And from there, that I started my journey on basically understanding wealth, understanding a lot of concepts when it comes to financial education. And after that, I realized the importance of financial education. So wealth engineering, it's basically mixing a lot of concepts that I learned from business, that I learned from engineering, put that together into actually how to engineer wealth for you and your family. And I talk about crypto mainly, but it's my channel is more about understanding the principles of wealth, and then you understand also because an engineer designs systems to be efficient regardless of the environment. And regardless of what engineers you talk to, that's exactly what they're doing, designing an efficient system regardless of the environment. And from this perspective, I realized, well, hey, how do you design a portfolio that can sustain regardless, that can be profitable, sustain your lifestyle, pay your living expenses despite market going up and down, right? And from that, that's basically the first question that I asked that led to a whole new path of me creating the principles of what I teach in wealth engineering. And I just use crypto as a vehicle to achieve that. So crypto is not necessarily the only way. Perry also talked about real estate. I'm in real estate too. Talk about stocks, crypto, business. Like business right now, I see it as a huge vehicle. But what I try to talk on my channel, especially in my course, is more on how to understand the best timing to get to the result that you want more efficiently. There are some certain times in cryptocurrency you don't want to miss, right? There is a cycle that you need to understand. And just like Perry mentioned, last year also was very great for me because I was able to leverage those timing and make some appropriate investments at the right time and also pull out at the right time. And then now it's like, okay, where do I allocate those investments next? Where is the next trend? Where is the next bull run? There's always a bull market somewhere. So when everything's going down, where is the next best choice? And I'm always absorbing a lot of information on a macro aspect to help me make the small decision on the micro aspect and leverage timing. And that's basically what I talk about in my channel. I make some videos about that, but especially in my course, that's where we really dive deep into that. And yeah, so dollar cost average is definitely a topic that I did myself at the beginning. I'm very like excited about this topic because it's something that you don't need you don't need to pay a course to know how to dollar cost average. It's one of the things, despite me trying to get the most efficient time, it's something about dollar cost average. You don't necessarily be worried about the timing. It's kind of like designing the strategy. and it's made for people who don't necessarily like kind of like have the time that or the resources or the passion like I do do all the little work. Well, it's just an easy way to still benefit a lot from the market and limit the risk. But I'm sure we'll dive deeper into that too. So I'm very excited about this topic, despite me being super specific on timing and the asset allocation. I still like to talk about the dollar cost average because I agree it's a strategy that is also in a long term efficient.
Exactly, exactly. So now, so the question that I have for you guys: do you believe that, because hindsight is 2020, right? So we would say that if if we could go back to 2008, how different would we make our approach? Knowing what we know now, how differently would we have positioned ourselves for 2008? Because a lot of what we're doing right now looks a lot like 2008.
Mm.
So so Perry, so tell me what you think you would do different if we could
Man.
go back to 2008, knowing the information that you know now. How would you have approached it differently?
Yeah. So, man, and it depends, and it does it to a degree. It does depend on where you're at, right? I mean, you got a family and stuff. We all have different things to take care of, but obviously, looking back at that time, looking now, my sole purpose would have been to just get assets. However, just get the asset, just get a hold of the asset. Now, obviously, get assets that you can afford to obviously maintain. You don't want to ruin your credit or anything like that, but that would be my sole thing that I would be focused on. Where back then I just wasn't. I was focused on making sure my credit was good and stuff, but I just didn't know what I know today. So my sole purpose would be get assets, and back then would have been houses, and now I'm in that same mode. It's all about getting assets, and still it's just like this. Did we know we were at the bottom? Nope, we didn't. But it didn't matter. You could have bought, and that's what you have to remember. You could have bought in 2008, 9, 10, 11, 12. You could have bought pretty much up until last year, right? And still made something. But so that's the thing is don't even try to find the bottom. Don't question it. And when it comes to the housing market, the thing I learned is just like this. When you go to get a rental property, a lot of times you're frozen like, man, should I do the deal or not? Doesn't matter. Get it under contract. Get it under contract, and you're going to at least you have control of it. And then if you don't want it, you have a clause in there where you can back out. So don't, but when you got a good asset, you hop on it. I wouldn't even second guess it. So that's the difference. I'm not timid about it anymore.
Yeah, definitely. What about yourself, wealth engineering? What's your take? Knowing what you know now, how would your aggressiveness been different?
You know why this question hurts? Because even when I didn't know anything exactly in 2008, I was actually in university. And then it was I was listening to Obama. I was in love with the Obama's speech. No, we need hope and change, right? Even back then, there was something deep inside of me that wanted to quit school, take all my money in school, instead of paying school, go to Las Vegas and buy a land and buy a house, properties there. Like something was really wanted me to do it. I end up not doing it because my father was like, whatever you do, make sure you finish your you get your diploma, make sure you got that finished, because if you quit, you will never get back. And I know myself, that's true. I would have never got back. And at the very least, I was 2 years in. I was actually starting my second year, so I didn't want to waste the time. And that's the only reason why I did not buy any land. So I didn't really know what to do, but I would have found a way to buy a house, because I was listening all over the place that properties were dropping like $30,000, $40,000 in Las Vegas near the street. And I'm like, something in me is like, this is valuable. like, it's not because there is something happening in a short term that the current value is actually 40,000. No, it is worth more than that, especially if you have a whole tourist area. Like at the time, there was no Airbnb, so I couldn't even predict that. But even back then, I'm like, I want to do it, but I didn't do it. And back now, knowing what I know now, I would have definitely do it. That's the first thing I would have done. I would have definitely go back there and then found a way to get a property low value that is being kind of like being declared as a bankruptcy, and then purchase about way below market value, below 50,000. Like people buy cars for 30,000, right? You could literally buy a property. So I would definitely do that. But knowing what I know now, I would do more than that. I would exactly like Perry said, buy assets. What I try to do is understand cycles, and when we are dropping in one market that is expected to be a high value, that's where I load up on it while it's going down, and then I ride it on the way up. And my favorite style of investing, I call it cash flow value investing, is when you hold an asset, it pays you now, and then it pays you over time with value appreciation. So when you get the asset on the low side, then you have a bigger margin you can make on over time if you hold it long enough. And if it pays you every day, then you have no worries about holding it because you're happy about holding it. And that's one way that I trick my mind to make sure I stay disciplined in that, and collect cash at the same time and increase my net worth every day, and also over time it increased my time. So that's what I would have done too. Back then, it was definitely real estate, and it would have definitely been stocks, tech stocks, right? Tech stocks back then. Cryptocurrencies were very too popular, but I think I would have stayed with these two sectors, especially prioritizing real estate, and then later started to diverge into stocks, and then ride it all the way down to 2015, 2016, and so on, and then back then make the transition to crypto. I think that's what I would have done.
Got it. Yeah, man, that's amazing. You know, and what you're saying right there, the cash value investing sounds a lot like what we do in real estate, is it not?
Yep.
Well, yeah, there's many different things people do, but I mean, some like Robert Kiyosaki, for example, he lives for cash flow, right? But his purpose, he doesn't necessarily want to sell the property. But me, I kind of want to give myself the option to. And if I can make profit out of it by, let's say, 100% out of my initial investment, then that's at least if I needed for another type of investment later on, I have the option. I don't necessarily want to sell it, but I have the option. And the other purpose that is serving is over time, my kind of like the mortgage is going down. I have more equity in the property. So basically my net worth is increasing too. So that's the two main purpose why I want to hold it and then decide what I want to do with it later. But yeah, that's exactly why most people invest in real estate, is for the cash flow. And by cash flow, I mean, you're not breaking even. Like you're getting more than what the mortgage and all the tax are all factor that in. So that's basically the idea. And when you buy a property lower at low market value, you increase your chance to get more cash flow in the property, right? Like you won't make cash flow if you buy at the top of the market where everyone is trying to do like a bidding wars, and then that's when you try to jump into a property. Like it's not the way to do it, and yeah. So in a way, real estate is technically a dollar cost average too, because as you pay the mortgage down, regardless of how the market goes, you're still paying the mortgage down, and it builds equity. So it's another way of doing the same thing.
Hey, I just want to point this out real quick too. I bought Facebook stock in 2012 for $28, and I bought $3,000 worth. Now I sold it. So what I'm telling you is be patient. But if I'm correct, at the height, I want to say at its highest price, it would have probably been roughly 3,000 would have turned to 41,000. But even today, after the market decline, it would still be worth almost $20,000 10 years later. So I mean, you can just think about all the possibilities there, and that was just 3,000. So it's about patience as well. It's just about patience, and I don't think I sold it because I was scared. I just want to take it and do something else with it. It really didn't make any sense. Put it that way. So
yeah. So what we're going to do, we're going to cover the definition real quick, and then we're going to speak to some things that are being observed in the marketplace, and then we can just really have some dialogue centered around that. All right. So let me share the Investopedia, because I love Investopedia. It does
Bible,
as well.
man.
I get an opportunity to skip a lot of steps. So here we go. Let me see if I can let me see if I can get my Zoom right. No, Zoom.
I don't know if you have a Windows. You can press Control and scroll with the mouse.
Yeah, nah, it's not.
You don't have Windows? All right.
Nah, I have a Mac.
All
right.
Man.
I think
that's pretty good.
Is 150 good?
Yeah, that's pretty good. That's pretty good.
All right, so here we go. Dollar cost average is an investing strategy in which investors divide the total amount to be invested across periodic purchases of a target asset in an effort to reduce the impact volatility on an overall purchase. The purchases occur regardless of the asset's price. Hold on. They happen regardless of an asset's price and at regular intervals. So now what this does, and the value of dollar cost averaging, is that you're not just taking a situation where you're doing. So the inverse of this right here would be lump sum investing, right? So what you would be doing is, let's say you have $1,000, right, and you want to invest your $1,000 over the period of let's say 5 months, right? Mm-hmm. So you could invest $200 every single month, and regardless of the given asset class or the different asset type, you can invest into that asset, and depending upon what the price is would really determine how many units you would be able to get. So let's say, for instance, in month 1, maybe each unit's $150, and you put $200 in it, so it gives you one portion. And then the next month, let's say it goes down to $100, then you would have a bigger piece of the pie the second month, although you're doing the same amount of money that you're contributing from month to month. So the value of dollar cost averaging is it creates an environment where you're investing at regular intervals, but it allows you to have equity positions that are different depending upon where the asset is actually valued in the marketplace. Were you going to say something, PerryUnlikely? Oh, I thought you were going to say something.
No, I'm good.
Okay. All right. Say key takeaways, right? Dollar cost averaging refers to the practice of systematically investing equal amounts spaced out over regular intervals, regardless of price. The goal of dollar cost averaging is to reduce the overall impact volatility on the price of the target asset. As the price will likely vary each time one of the periodic investments is made, the investment is not as highly subject to volatility. And it says dollar cost averaging aims to avoid making the mistake of making one lump sum investment. That is poorly timed with regard to asset pricing. So the inverse of dollar cost averaging is a situation where you would take that $1,000 and you would invest it one time into this one asset. And so what it does is exposes you more to the downward cycle that would potentially happen, and you would potentially lose more, as opposed to you being impacted over a periodic time. You wouldn't be exposed to as much volatility, given that you have not contributed the whole $1,000 balance. Does that make sense? I mean, I know it makes sense to you guys, but essentially that's I just want to make sure that I'm explaining it in a way that makes sense. Mm-hmm. So dollar cost averaging is regarded to be one of the premier strategies for investing, given the fact that it's something that that happens over a long period of time, and it's designed for people who are not seasoned investors, right? It allows
Yeah.
people to have more, like I said, a more conservative approach, while at the
Mhm.
same time allowing them to benefit from the upward cycles that could happen in the marketplace. Were you going to say something, wealth engineer?
Yeah. I just wanted to add a little bit more into this definition here, kind of like breaking it down and making it even more simpler than what is being described here. So the way that the way I like to think about investing, right, is if you buy a candy for $1 and then you basically you try, let's say you had a business, you want to sell candies, right? You buy your cost is $1 and you're hoping that you could sell it for $10. Right? That's a huge profit.
Yeah.
Business is doing good, right?
Yes, sir.
Now when you dollar cost average, it's basically when the price of the candy can basically fluctuate. Maybe one day it's $1, maybe one day it's 50 cents, maybe one day it's $2. But if you buy it, let's say once a week, every week, what's going to happen is your average cost is going to be a certain amount, right? What you don't want is you don't want to buy the candy at $1 and then the price goes down to 30 cents, right? So when you do that, your average cost stays at $1, and then the price on the market is 30 cents. So basically, you're losing money, right? Whereas if you're a dollar cost averaging, your average could have been maybe 70 cents, maybe 60 cents. So you're still losing, but the risk is less, right? And the reason why it's less is because you buy a small amount at $1, you buy a small amount at 90, and you kept buying all the way to 30 cents. So your it's a strategy that not necessarily focusing on profit, it's more focusing on limiting risk. And if you don't understand timing, so it's doing two things at the same time. It's helping you manage your time in the market, and also your risk, your allocation. It's better to reduce your risk to 60 cents so that you can make $10 versus $1, and then you're risking all that $1, but you could also make $10 if it goes your way. The other thing I wanted to add is, yes, it's a beautiful strategy. It's a conservative strategy to limit risk. Especially if you don't have time, to understand the charts, to go on the news, to watch everything, to understand the best timing. Beautiful, but there is a catch. There is a catch, and that the catch is not necessarily often spoken about. It's you gotta do it for investment that are worth that are worth it. And what I mean by that is you don't want to go on a penny stock that is super risky, and then you're going to tell yourself you're going to dollar cost average. Well, you're going to dollar cost average, but let's say you dollar cost average on your way to Luna, for example, which there was a time it was a great investment. I know because I made a lot of money in it, but right now it's going low, and right now it's going low, and there is a lot of risk in investing it now. And you might say, well, I'm going to dollar cost average, but what if you dollar cost average and it never goes back up? So you're not necessarily making any profit. Your average cost is still low, but you're not opening yourself for room to make more money on the upside. So you got to also spend the time, educate yourself. And if you don't really know, then at least go with an ETF that has a lot of good basket of stocks into it, maybe on the tech, maybe on utilities, commodities, like any things that you can do to limit and spread out the risk. And then you focus only on one, and you dollar your cost average your way there. It's just a beautiful strategy over time, and it can serve a good. It can basically manage your wealth in a way. And we're talking about wealth for your retirement at this point. It's a long term strategy to limit your risk over a long period of time and to manage your wealth for retirement. So that's what I would definitely say. The caveat to that is it's doing two things at the same time. It limits your risk, and it helps you spread it out over time so that you don't have to master understanding exactly the best time to do the lump summing.
Very true. Very true. Yeah, and I completely agree with you. Something ETF or Well, you can start out with an ETF that exposes you to either the S&P 500, or you can do an ETF that exposes you to the total stock market. So just pay attention to the expense ratios that are associated with the given ETFs. But those are great places to start, and it creates an opportunity for you to at least have something that has an upward trajectory. And of course, past history is not indicative of future gains or future history. So you can't say with absolute certainty that these asset classes are going to be guaranteed to go up. But you can look at them from a historical standpoint and tell that they have an upward trajectory. Like I said, a VTI, a VOO, SPY, any one of those ETF or asset that have like a basket of different companies that are in there that are part of the market leaders as far as innovation and productivity overall. So I definitely agree with that notion. So just to ask you all a question, right? So what do you all say about the market that we're at right now, right? So we were speaking earlier about how the real estate market, I'm seeing a lot of people now come out and say that, people shouldn't be buying real estate right now, at least not on the MLS, not on the multiple listing service. I don't know if it's called the MLS up there in Canada, Wealth Engineering. But, people, I'm seeing now investors that are saying, don't invest into the MLS, invest into real estate, but don't buy properties or deals that are on the market. Buy something that's for sale, but not something that's on sale, And so what do you all think about that? I'll start with you, PerryUnlikely.
All right. So, yeah, I actually think I leave all avenues open.
Yeah.
Right. The MLS, yeah, it's going to be more of a bidding war and more overpriced, right? But still, you can find some opportunities there still. I mean, there's always going to be opportunities. But, yeah, I think now calls for more so off-market opportunities, in real estate and value investing as well. Finding something you can force appreciation and not necessarily here's how I look at it, because you got to change with the market. So right now, because it's overpriced, right? You have people that are flipping houses. They're probably at the point where they're like, man, these prices are too high. But if you can come in as someone who's not trying to flip it, but someone who can get a deal like someone who's flipping does, but you're going to maintain it for your own rental purposes, then, you may be able to pay slightly higher than the person who's flipping houses. So you can beat them out of it, but not because you don't have to do as much to it, but not so high where it's not a good deal. So it's still about finding the right, deal. And the reason why I think with real estate, it's a little bit different for the most part, right? Unless we're talking about like REITs, real estate and real estate investment, like funds, right? A trust. The thing about that is it's a little different because when you buy real estate flat out, you're not dollar cost averaging for sure. I mean, you're pretty much going all in, and why you shouldn't time the market. Because think about it. People were saying the market was overextended in 2017 and 18. But for me, there is data you can use though. That's the thing. We can look at the average home prices, average home prices. Are they dropping? The inventory. So there's a lot of stuff you can use in real estate that lets you know, okay, it might be time to chill. So why you say don't time the market, I think with real estate, we're to a point where you have to look at it. You just have to pay attention to it. And at the end of the day, for me, when it comes to real estate, you use a formula. You look at the cap rate. What's that cap rate at? And I don't care what the price is. If the price can be as high as it wants to be, but if the cap rate's still 10% and those are true numbers, it's a good investment for the most part, I mean, give or take, but for the most part, because you always have to do maintenance and things. And then just for the other parts of the market, I'll just second that. I definitely like the DCA. I mean, I love it. It's just, and it just puts it on, it leaves the emotion out of it. It just leaves the emotion out of it. Very simple. Every Monday I'm putting $100 in, don't care what it looks like, and I'm just going to do it. And that it makes it a lot easier than trying to time it, because I can tell you right now, if you're going all in, 90% of the time it's going to feel like right when you go all in, the market drops and you're like, man, I could have got it for cheaper. It's going to do it to you every single time. So just go ahead and put that 100 in there every Monday or every Friday. Matter of fact, most accounts have it set up now. You don't even have to physically do it. It'll just draft it right out. It just makes it easy for you. So absolutely.
Cool. So I'm gonna go ahead and define cap rate. So cap rate is the capitalization rate, also known as the cap rate. It is used in the world of commercial real estate to indicate the rate of return that is expected to be generated in a real estate investment property, right? It says capitalization rate is calculated by dividing a property's net operating income by the current market value, right? This ratio expressed as a percentage is an estimation of investors' potential return on a real estate investment, right? Cap rate is most useful as a comparison for the relative value of similar real estate investments, right? So this is what you just spoke on right here. And the net operating income, we're going to pull it up here in a second, because we really want to have graduated conversations here where we can make sure that no one feels left out, right?
Right.
And we can have a conversation amongst people who are in the know, as opposed to people who are out of the loop, right? Net operating income is a calculation that's used to analyze the profitability of income generating real estate investment. NOI equals revenue from the property minus all necessary operating expenses, right? So it's the money that's left on the table after all expenditures have been explored. And NOI is a before tax figure appearing on a property's income and cash flow statement, and it excludes principal and interest payments on loans, capital expenditures, depreciation, amortization. When this metric is used in other industries, it's referred to as EBIT, right? Which means earnings before interest and taxes. What is that? What's that scene from the? What was the name of the movie? Was that? God, what was the name of the movie? Do y'all remember the movie where the guy came into the boardroom and there were a bunch of other people in the room, and he was calling it EBITDA?
Well, yeah, that's pretty much.
But there was something really funny. It's like he didn't know what it was, and he was trying to.
No, yeah, I know. It's one thing. Whenever I see it, I'm like, yeah, EBITDA.
EBITDA. Yep.
Yeah.
So check this out. Look. So we went over that, right? So and wealth engineering. I want you to go ahead and speak to the question that PerryUnlikely just answered, and speak on how. Why am I at a loss right now? Now I'm drawing a blank real quick, guys. I think he was talking about dollar cost averaging. I don't know what happened. Dollar cost averaging. I'm struggle streaming. Dollar cost averaging and.
Yeah. Don't worry. I'll slide in. So for me, especially we're talking about the real estate market and is it a good buy? Some people are saying it's not. Me and maybe I guess that's where I might have a little pushback with Perry here, but hey, it's all respectfully, right? Well, before I say that, I would like to say this: it's not like everyone is right. To me, everybody is right. It all depends on their goals, their expectation, their strategy. So because the strategy might be good for you, it might be not good for someone else. I'll give you an example. Dollar cost average is a great strategy for everyone. However, if you are the type of personality that is super aggressive, that is you can handle risk, right? You're very comfortable with risk. Well, you're actually not going to stay too disciplined with dollar cost average. And I know because I am that type of personality, right? So you're going to start doing it 3, 4 months, and after you're like, I just want more, right? This type of personality, it's very impulsive and they greedy in a way, right? So that's the downside because it doesn't, it's, it, you have to get hurt many times before you go back to it and be like, okay, yeah, I better dollar cost average my way down. And now that's actually what I'm doing right now. I'm doing dollar cost averaging, but for a specific time frame. And because I know my type of personality, I know my type, and what I'm doing is I'm saving for when I hit the bottom, and I have learned the skills on how to learn how to understand the bottom on the stock and crypto market. So I'm trying to do better at that on the real estate market. But for the most part, I have some good ideas on how to look. And basically, what I'm dollar cost averaging until it reach the ideal phase that I want it to reach, and then that's when I put the lump sum, right? Because me, that's the type of investment that suits my personality. Like I'm very huge in matching your personality with your investing style, because that's what is going to keep you disciplined on it. And discipline is the number one way to make money, and discipline and timing is if you can master those, you can make money on the stock market. So at least dollar cost average for the average person is going to help you stay disciplined and also manage timing. So that's why it's a good strategy. But I also want to add the personality type. So for me, like I said, to me, the market is too high right now. Based on my personality, my goals, I go extremely. I like to buy things extremely low. Like when bloods are on the streets, people are liquidating everything, bankruptcy. That's when I love to go get it. And right now, it seems in North America, I can't find deals like that anymore. So I have to go elsewhere. Like I'm looking at international real estate where I can scoop things like pennies on the dollars. And this is the type of investment that I love. And I'm also doing studies and research to understand, okay, based on 2 or 3 years down the line, how is the land, the environment is going to change to my benefit? Are they going to add an airport next to me, right? That could raise my real estate property right there by 10x. So things like these are things that I'm looking at. I got to a point where 100% return doesn't excite me anymore. If it's not 10x, I kind of like, I don't really want to look at it. I mean, this is for me, right? Like I said, it's a different type of investing. But to be fair, I have a one cryptocurrency right now that I'm looking into, that I'm dollar cost averaging my way in, because we haven't hit the bottom yet. And then in other cryptocurrencies, I'm doing the same. Why? Because to me, there is a time to do it, but also there is a time to go all in. And that's I mean, this is for people who are more versed into a different style of investing. But I like to, regardless of the market, whether it's stocks, real estate, whether it's exactly real estate as well. I love to understand the timing, and I know myself. I love to get it when it's extremely low. And right now, regardless of where you look at in North America, it's too high for me. But for someone else, it might be not high, not as high. It might be somewhere in the middle, and it really depends on your style. But you got to stay faithful with that style. And where you lose, it's where you start with one, and then you jump on another one, and then you jump on another one, and 10 years goes by, you end up not going nowhere. So whatever you decide to do, stick with it, and then you become better at that same thing. And that's how you make money as well on the stock market and
Hey,
investing in general.
so I got a question for y'all, right? Given where we're at right now, right? Because we're getting ready to talk about like the countermeasures that are being suggested, right? Do you guys want to see blood in the street? Given how toppy the market has been lately, can you guys actually say that y'all want to see blood in the street, or do y'all want this thing to bounce back like they're suggesting that they want to bounce back?
Let me chime in very quick on that, man, because it's speaking my language. You may not realize this, but people in my exclusive discords, They know exactly what I'm saying. Like I have this expression where I say wet, and I usually say that when there is blood in the street, because why? This is when I'm excited. This is when I'm super excited because I'm realizing so many people don't realize the opportunity that they hold. They sell it, right? And then they're dumping the price down, and I can get more of the assets for less dollars, right? Me, I don't look at the price that I'm paying for an asset for. I'm looking at the amount. So if I'm buying a stock, I'm looking at the amount of stock that I get. If I'm buying a crypto, I'm looking at the amount of crypto that I get. And I want to maximize that amount as much as possible. So if I'm looking at real estate, it's the same thing. I'm looking at how much real estate. I'm not comparing that with the dollar amount. I'm comparing that with the asset amount. The more asset you have over time, if you play your cards right, it's going to increase your net worth even higher. So from that perspective, it is extremely important to me to buy things when they're super low because I can get more for my dollar. I can stretch more for my dollars. That's how I beat the 100% ROI easy, because I get it so low that regardless of how much it decides to go up, I'm always going to be like, my risk is so low and my potential of profit is so high. So that's why I look at markets and I want to see blood in the street, especially for the cryptos and stocks and real estate that I'm looking into, that I'm waiting and I want to buy. And yeah, I live for that.
I'm the same way. You may hear my son yell, by the way. It's bedtime.
Nah, it's cool.
Look, at this point, look where the market's at. We're darn near, there's blood already, so you might as well let it just rain. And the way I'm thinking about it is this. So 2018, and I'm just using this as an example. 2018, Cardano goes to, don't quote me on this, but it'll be close, like $1.33. So when I got into crypto, the first thing I did, I just literally started looking up at charts, looking at the height that they had hit. I didn't care. I didn't know anything about crypto, but I knew that they had been here at one point in time. And if they got there once, they'll get there again. So I started doing, how many X's is that? And one of the first ones I saw was Cardano. I was like, oh, crap, 2 and 3 cents? Oh, yeah. I started loading up on it. So I watched that and didn't do anything. I watched it rise all the way up to, I want to say I watched it rise up to like $3.11, right? So I'm already looking right now. Cardano's come back down. It's sitting around 50 cents. So I'm already thinking, oh, so I might get a 30 cent Cardano. I'm all up for it. And I'll start load and I'll be loading up. So I'll dollar cost average now, but if I get around 30 cent, 35 cent, 40 cent, I'm just going in heavy. And I think in a couple years, right, then I may see that $6 to $8 Cardano in the top of that cycle, because we didn't get the traditional top that we've gotten in past years, and some of that stuff may change. But what I do know is, well, I don't know, but what I do feel is, will I at least see a $3 Cardano again? Yeah, I believe I will. And I believe I'll see it higher. So if nothing else, I'm just loading up, waiting on if I can throw 10 grand in there, I can get, I can get at least pull 100 grand out when it gets to, if I get it at 30 and it goes up to, and it goes up to $3. So that's the kind of the way I think. So, and I think very much like wealth engineering, I'm not even paying attention to the price. The price is already good. The price is good on everything right now. I'm looking at how many can I get. I'm always like, all right, I need 100,000 Cardano. It's like shopping at the grocery store. If I want oranges, I'm not worried about the price of oranges. Give me 3 oranges, give me 2 apples, I'm just grocery shopping and grabbing what I need. So that way I've kind of got rounded numbers on what I got to make up my portfolio. So that's like, if you were to see, I saw Bitcoin. I remember when Bitcoin hit, it was like around $8,000. And I was like, let me go ahead and get a half a Bitcoin. It was on a particular day. I'm like, let me go ahead and throw 4,000 in and get a half a Bitcoin. So I'm always just looking at the number. I don't even look at the price. Now, when we're talking a $68,000 Bitcoin, yeah, I'm looking at the price. So even to this day, while the market is bloody as can be, I've got more money in NFTs alone than I ever put into the market to begin with. That's just the NFTs. That's not the other, but it's just because I never went into the negative, but it's because I just looked at getting as much as possible. So even though it's bloody, I'm still up, but that's over several years. So I just want to make that point. And if you get it when it's low, you have that luxury. That's why it's so important to take advantage when you can. So although Cardano at 50 cent looks bad, it don't look bad when you were buying at 3 cent and 11 cent. So that's and 15 cents. So that's kind of the way I base it off. So yeah, I'm loading back up is the way I look at it.
I mean, this situation makes me think about the movie The Purge, right?
Yeah.
and here we are now getting ready to go out there and hunt, and it's a wild thing because I can think back as far as back even 2018, like you're saying, right, where people have been talking about I'm saving, I'm stashing my money, I'm stashing my money for me to see the bottom. I want to see the bottom, and so now for us to be having conversations about like, oh yeah, all right, guys, now it's here, right? What are we gonna do? What are we gonna do in order for us to counter it? And I think the people who are in position are saying, hold up, don't counter it yet. Listen, let me get my piece first before you guys start countering anything. Let me play a little bit, and then you guys can go ahead and allow me to go ahead and ride this thing up. I just don't see the people who are in true position, and I'm worried of even the people who was talking about sounding the alarms. I saw that in 2020, where the people who were on these platforms, like this one right here, I have pulled up, who were on these platforms saying that doom and gloom, the world is getting ready to do this and that. And then you see a couple of days later, they were betting towards that event actually happening, and then they had an opportunity to profit from it. So it just seems like really, really, we can say unfair, and it's a little bit of a manipulation, because now they're on a platform where they're sharing this information to the better part of society. But I can say that, I don't know if I'm ready for them to restore everything. What were you going to say, Wealth Engineer?
Man, me in the news, man, like honestly, the way I look at the news is kind of an indicator to know where we are in a cycle. Like if it's starting to be in platforms like CNBC, like Bloomberg's and all, then I'm like, okay, we're towards the end of the cycle. Or well, there is a catch to that, unless it's going to be something so massive that they need to let the public know and train their minds before it happens, so that they can say they have an excuse and kind of like for some level of credibility. Like for recession times, they tends to do that. Well, just when it's about to blow up, they are about, oh, you know what? Is it should we think about recession, right? And then a month later, hey, experts are saying we might hit recession, and then every day it's like, oh my god, we are in recession. Like, but if you what I've trying to do is, and that's what I call understand the forces that can affect your wealth. It's basically couple macroeconomic trends that you can observe, and you can always stay ahead of the market. And me, especially me, that I want to buy things so low, I have to be ahead of the market, and sometimes I am 2-3 years ahead. So I think I'm at the right time, but I have to wait 2-3 years before I get my prediction to happen, right? But based on the information, it's kind of like math. Sooner or later, it's going to happen. So, but it requires extremely patient, and sometimes I'm using dollar cost average as a strategy just in case I might be wrong in my prediction. So I'm like, at least I'm dollar cost averaging my way in, and then this opportunity I don't lose on it. But but if my call becomes right, then I have a huge saving waiting for it, and I load up on it and grab it at the time when it's super low. But how do I know that? It's by looking at the media. When I see the intensity, the trend, and I was paying very close attention to that since last year, because I was expecting them to talk about that since 2020, since April 2020. right? I was expecting them to talk about that, and they have not. They actually help the market. They actually help push the market to all-time high, the stock market, right? We had the V-shaped recovery, and I was like, the higher it rises, the harder it will fall. And let me be blunt with you guys. We haven't started the blood yet. We haven't started the blood yet. Based on my macro research, we're this is just kind of like a bubble that is about to pop. And then this is right now we're just feeling the needle. What you're currently seeing right now with the market, and you see how Netflix, for example, has lost so many gains. The blood hasn't started yet. When the blood is gonna blow up, it's gonna be so much worse than that. And this is the scenarios I'm like, yes, baby. And so every time I see articles like this, I see CNBC promoting or talking about, or like you said, manipulating the market. It's not that they're manipulating it. It's kind of like right now, especially for the recession part, they're kind of like they know what's coming. They're saying it now because there is no way out of it, and then they're saying that so that they can say, "You see, I told you so." Right? So we have credibility. You should listen to us. But if they were honest, they should have talked about that since 2020 because these were predictable and what you're currently seeing in the market right now. And it's all about understanding timing. And if you can do that, you can make a lot of money because buying a lot of cryptos and stocks at the right time can help you reduce your costs and then increase your margin. But if you don't know it, then yeah, dollar cost average as well. It's still in and it's better than nothing. So that's my take on it.
Yeah, so it's really interesting, man. So I'm just watching it. All that I can hear. Next time I come up here, I'm gonna have the purge sound, with the siren, with the citywide siren that's going off. Because I think that people who've been preparing, they want to taste blood, man. Like I hear people who are talking about the market is going down, but they're not saying it because they're concerned about what's actually happening. They're saying in order for them to get the conversation going, and they want things to be working in their favor. They want things to be moving in their direction, and so I'm interested to see it. So what we're going to discuss is what Jim Cramer has said that issues that the Federal Reserve needs to address. Right? He says he went through a list of economic problems that the Federal Reserve Chair Jay Powell needs to address to tamper down inflation and in turn help the stock market rebound. Right? Right? He says if Powell can slay these seven dragons, then making money in the stock market will come easy again. Until then, though, expect more horrific days like today. Listen, I think there are plenty of people who want to see horrific days that are to come, because the better the position they can put themselves in, the better they can have an opportunity to capture the growth. So it sounds like maybe he's concerned, but let's show us your portfolio, man. Stop talking. That's what I say. I don't want to hear what you're saying. Show me your portfolio, how you really betting going into the future, and then we can really see if your sentiments really come from a place of genuine concern, right? So here he says, right now Powell's losing too many fronts, which means that he has to get more aggressive about raising interest rates in order to cool things down, right? He says Powell does have a daunting task, though. The Mad Money host says there is a huge schedule of things, and here's the list, right? He says, here's the list, right? He says housing, right? I think mortgage rates must grow to 7 or 8% before it's just too expensive and new homes coming down in the price, right? He says Powell has a lot of wood to chop to get rates that high, but it must be done, right? He says the auto industry, right? He says Powell has to choke the demand for cars, and the best way to do that is to raise interest rates, right? We need a glut of cars to solve the intractable problem, right? Then the semiconductor makers can catch their breaths. Now, mind you, I work in the tech space, right? So way back in 2019, right? We had a chip shortage way back in 2019. So we can maybe say that this is a result of a pandemic, but we've had the sourcing issue, especially as far as semiconductors. We've had the sourcing issue for quite some time. So we can't really say that this is something that's a result of what's happened recently, right? Right? Then he's saying that the labor, right? He says companies that can't afford to hire people here, the less we need to work, excuse me, the more companies that decide they can't afford to hire people here, the less we need to worry about a wage price spiral, right? He's saying issue number 4, Russia's invasion of Ukraine. Kramer said that while Powell does not have control over this outcome or duration, the war is causing commodities price, including oils and grains, to skyrocket, right? Then he also is saying that the high freight cost, either a slowdown in commerce or an increase in the number of drivers, will help on this front. So, okay, so you want more freight trucks out there, but you want less of a demand in the marketplace as far as people in the auto space. So that doesn't really make sense, right? So then we have plane tickets need to get so expensive that people travel less and in turn spend less, right? And then he says consumer savings glut. People need to spend their pandemic savings so that they are motivated to go back to work. Wow. Now, after we've reviewed that, man, I mean, geez, those are a lot of things. And who's really benefiting from majority of those things, right? Talking about a housing interest rate increase. You're talking about an auto industry, auto loan interest rate increase. You're talking about people spending their pandemic savings. I mean, come on, man. Who wins in that type of situation? It's just wild to me. I don't get it. It's interesting suggestions though. But go ahead, Perry.
You got a blue hat, man. There's a lot of that I'm not buying, man. First of all, the pandemic savings. I'm still having a hard time. We discussed that. Where do people have so much savings? I mean, we see the statistics. Where do people have so much savings they can afford not to work? Right. So I don't know about that. Excuse me. The high freight cost, slowdown in commerce, not going to happen. In my opinion, anyway. Increased number of drivers is not working. Been a driver shortage for as long as I've been in this industry. Been a driver shortage. So that was a massive problem anyway. And it's, talking 100,000 drivers or more. So some of those is definitely wishful thinking. So yeah, I don't know about that. I don't know about that. And just as a joke, the airfares, even if the plane tickets do get expensive, there's so many fakers on Instagram, it won't look like it. It'll still look like everybody's traveling different places. But no, seriously, I think he's a bit off on that. I mean, the housing piece, yeah, 7 or 8 is high, but you got to, I mean, a lot of people don't realize, in the 80s, they had 18% mortgage rates. I mean, so I don't agree with him 100% on that. I just don't. And like you say, where does his interest really lie? So we shall see.
I mean, he's suggesting the true case of the haves and have-nots,
Yep.
I mean, because if you're talking about 7-8%, like I can see 7-8% of a marketplace that is realistic, not these inflated prices that are out here in the marketplace, because you can't be overpaying for a house and also paying 7-8% interest,
Yeah, I agree. Yeah, I agree. I definitely agree with that. But one thing we do know too, the market will balance things out. It always does. I mean, it'll definitely balance things out. But sure enough, man, these prices have held. It's crazy. They've been holding up strong, and just they're not going down yet, not really. But and remember the meeting is tomorrow. I think they're releasing meeting notes tomorrow, so we'll see volatility tomorrow for sure. We're likely to see some volatility. The FOMC meeting, the notes will be released tomorrow anyway, and that's going to cause some volatility. Especially, I mean, it's going to cause volatility in all markets, to be honest. So I'm going to pay attention to that. So, by the way, I just want to mention real quick. Like Wealth Engineering says, as far as staying on top of it, that's how I am too. So, for example, I don't know what those notes look like. I don't expect it to be great. In the case that it's not, and I'm just naming one, but ApeCoin is sitting somewhere around $7, right? I think 717 as I checked earlier, 730. If that bad news, I see it drop to $5, I'm scooping a fat bag of it. Why? It'll settle off. I'll see it back at 750, and I'll make a 50% return. It happened 2 weeks ago. It continues to happen. When the market is red and people are in fear, that's when I act. And that's when I act with large lump sums of money. But here's the deal also. Say I'm wrong and $5 goes to $3. I wait it out. It don't make me a difference. It just becomes a long-term investment. So I keep certain amounts to where those investments just have to become something else. If it works out well, I'll take some off to get ready to move it into something else. But if it goes down to $3, it's going to come back. I know the utility it has. And okay, boom, this one just becomes a long-term investment. And then if I do want to move it, I may consider moving it when it comes back, but I'm not worried about it anymore. It'll just stay there. I don't care if it's a year and a half. That just money becomes having to just sit there. That's the way I play it. I mean, so and that is where when you don't dollar cost average, you got to make sure you don't put everything in. Like you got to have, if you got 10 grand, don't put it all in, like maybe put 4,000 in. So you at least have 6,000 left, so that can sit and you don't take a loss. And you can now a trader wouldn't worry. They'll hop out of the trade and get in something else on the way back up. So there's different strategies. But if you're more of a hold type person or a swing type person, then I would play it like that and then allocate my other funds to something else. So
yeah. Let me chime in a bit. Do you mind sharing that article again? I want to break it down point by point, man. This is madness, man. But let me tell you why none of these will happen, right? Now, it was saying housing needs to go, 7-8%. Now, I agree with you. In a normal market, this is what's supposed to happen. And we were supposed to have that since 2017. Since 2017, we're supposed to have the interest rate, the mortgage rate and all to be like around 7-8%. But we didn't. Instead, we were cutting, we had lower interest rate that was allowing people to borrow more money that create this bubble. So now we're in a scenario where if he increase the interest rate just by 0.5, 1% and all, it's just going to create a bubble. It's going to bust the bubble that is already created. Imagine, just like you said, overpaying for real estate, and then you're overpaying also for the interest rate. So it's a catastrophe, and there's so many people that have money in real estate that was riding that high bubble that it's going to create a problem. So that's why it's a checkmate. It's a checkmate for the Federal Reserve because they have been in these scenarios for the last before 2020. So basically, since 2018, to be honest with you, I've been observing this. They've been in a checkmate scenario where if they increase the interest rate, they're going to bust the bubble, and then if they don't increase, if they don't lower the price, if the people are not borrowing more money, then the bubble busts also. So they're damned if they do, they're damned if they don't. And what they're trying to do since basically the last 2 years is raise it just a little bit so that they can drop it. And then they've been playing this game well, buying time. But this is just buying time. it's not going to solve the issue. And I disagree about this statement from Kramer, because yes, that's what they need to do, but they're so late. That's not they needed to do that like years ago, not now. Now, regardless of what they do, it's gonna crash. So maybe they need to do that so that they can end up crashing it, and then we're gonna see blood in the street, right? So auto, there have been an auto bubble for a very long time. Um, there's a lot of cars, new cars that are not selling, right? There was a time second-hand car was selling way more than new cars. So I don't know what you want to do with that, but you raise interest rate on that, it's not going to help. It's just going to have more inventory, and you're going to be manufacturing cars that you're not selling. So this is just a bad idea. This is just a bad idea, just perpetuating. But again, that's the other problem. Yeah, that's another example of the checkmate, right? If you don't increase the interest rate, what is that going to happen? More people are going to borrow more money to buy more liabilities, car included. So you damn if you do, you damn if you don't. So yeah, it's a real catastrophe when you understand how the money system works and where we are right now. Which is why I'm saying we haven't started the blood yet, guys. We haven't. Labor, right? Saying that uh, we need to worry about the wage price spiral. Um, Companies are going to look more and more about remote work. I don't know if you guys noticed this. A lot of companies are applying for remote jobs, but now, which is a good thing, because now you don't necessarily need to go to work. But the bad thing about that is your job is open to the world now, as opposed to just your country. So, and what does that do? You got more people chasing the same job. Wages are going, not necessarily increasing, they might stay stable. And especially in a recession, what does happen? Wages go lower too. So it's layoff happens. So yeah, whatever he's saying right now is wishful thinking, right? Russia invading Ukraine, causing problems with grains. Like, this is one of the biggest issue that is happening right now that no one is talking about. There is the price of fertilizers rising. We're talking about like 300%, 400% price rise. And what does that do? There is a large portion of the agriculture that is nourishing the world. We're talking about like countries like India, China, Russia. When it comes to wheat, 20% of the global wheat production and exportation happens in those countries. And we're talking about like 20% of all calories comes from wheat. So if these countries are in a political turmoil or war, they decide to ban, and I repeat that again, they decide to ban exportation to unfriendly countries like us, and then we're not producing at the same rate as them, right? They control a large portion of the market. Wheat is used in almost everything, so that creates another price hikes, and in everything, in agriculture, and then that's going to affect transportation. That's going to affect everything. So fertilizer pricing rising, and also wheat, just wheat alone. We don't even have to look at other commodities. Wheat and fertilizers, those prices are rising so fast that it's almost creating famine situation for developing countries, and it's going to affect big countries too, because we're in a scenario where we're getting pressure from the mortgage, the interest rate that might rise, that might pop the bubble, creating a recession, inflation, and then also at the same time we're getting living expenses such as rent and food rising very fast, and energy. So we haven't seen the we haven't seen it yet, guys. So that's what I do. I look at the macro aspect and try to see the clear picture, and then use that to be able to predict what's going to happen and how it's going to affect the market. Airlines, like, it's talking about high freight costs. I understand what he's trying to say here, that high freight costs, because um there was a scenario, and a lot of these issues happened before CV19, but then CV19 made them even more pronounced, right? even more pronounced, so that he's trying to find a way to solve the short term scenario. But even the short term solution is actually going to create a bigger long term issue. So it's not going to really be like it's, and that's where I'm starting to question his intention here. He's not really speaking for the average man here. He's speaking for the companies, because on a short term way, that's going to help the companies managing all the inventory that they have to manage. But he's not necessarily helping us, because that's going to lead to more issues later on. And like airfares, like that's clearly, that's obvious right there. And then consumer saving, like from an economic perspective, what he's saying actually makes sense. I want to give him that credit, but the concept or the timing for this is not there. What he's saying on the consumer saving here is there's something called a velocity of money, where you how you increase the GDP is when I have a dollar, I buy something for you. That same dollar you use it to buy something else, right? So that's a velocity of 2 right there. And then if that dollar goes to Perry, so that's velocity of 3. So the higher the velocity of the money, the higher the GDP. And basically what he's trying to simulate is the GDP growth, right? Which is technically good for the economy. But then that's not a good timing for it, because hey, in a recession, especially when you have a looming recession, and now it's going to be different, because even agriculture is, and energy and food are going to be affected too in terms of high prices. So it's not the time to be spending your saving. Absolutely not. This is a time this is the time you really lock down on everything. You save as much as possible. You stash up on your potato and you put it on your freezers. You try to buy meat for a year, beans, right? Get some wheat, pasta, any food that can last a long time. And then you stock up toilet paper, man, because we know that can cause a crisis. And then and then you do not listen to this guy, man. You do everything opposite in what he's saying, and you'll be right. But
Exactly, man. I mean, who you advocating for, man? I mean, it's completely bogus, man. I mean, okay, yeah, maybe for the haves, right? But not for us, right? Not for the regular people, not for the people who are not in position yet, not for the people who are not prepared to see the blood in the streets, right?
mm,
So here we go. So we're gonna address some people in the chat. Excuse me, man. Let me
yeah,
see. I'm
yeah.
still
Very
scrolling.
quickly, I also wanted to mention very quickly, um, big legacies. We're talking about like the wealthy, right? The
The
old money,
oligarchs, yeah.
the old money. Where how they get created is times like this. So the doomsday scenario that I'm describing, they're actually excited for it. Why? Because that's what turns it's kind of like the passing the baton to the new guards of the oligarchs of the 21st century, right? That's basically what they're doing. It's like this is how families that can last dynasties like are created. So, and how do they do it? Is they wait for scenarios like that where everything is liquidated, everything, and then they kind of like, hey, Warren Buffett is currently doing that right now, and he's been doing that for years. He's been sitting on billions and billions dollars of cash. Why? It's exactly for what's coming, and he knows what's coming for many years, and you can see that on his action, how much cash he's sitting on right now, right? What is he waiting for? He's waiting for to buy huge assets, pennies on the dollars. I bet you one of the first things is going to load up more than he already has, farmlands, right? Farmlands. He's going to load, I bet you, he's going to load up more than he already has a lot. He's going to load up more. They're going to go buy traditional assets that are going to gain more in values, but are going to lose a lot of value in the short term. And that's when they load up on. And you buy more company that has potential, that are paying good dividends, that are potential to last long. You buy them at pennies on a dollar, and then you just sit. And many people are going to be doing that to the haves. They're going to. That's how rich people get richer, right? They wait for to buy everything on sale, and then they ride the wave all the way up, and just multiply their wealth that way. So So that's what's happening right now. He's not speaking for the average man. He's using the average man as a way to promote, kind of like trigger the bear market to start way earlier, and so that the haves can buy at the discount.
Yep. Spot on. I mean, self-interest. I mean, it's that simple. I mean, yeah, use up all your savings. Yeah, I mean, that's crazy. That's just crazy. But yeah, he's just promoting his own interest, which I'm not surprised. And he's got buddies who got, I mean, he's got some bread, I'm sure, but he's got buddies who got a lot more bread than he does. So absolutely. It's crazy. I mean, to me, when the pandemic started, they should have just dumped this thing into the ocean. It was already headed there. Just let it fall off the face of the earth is what I think, and suffer through. And if you make it, you make it. If you don't, you don't.
I mean, pride aside, man. Like throw pride aside. Let it go to where it's naturally supposed to go. That way we're not in like this huge deficit that we have now, and just let things bounce back like they're supposed to,
Political pressure.
But instead, what happened? Instead, they print so much money that 40% of the entire US dollar supply was printed in 1 year. That means, it basically means everyone that was saving money on the long term, it made them stupid, because now they printing the money faster than you can save it. And if you had $10,000 in your saving account, you're one of the rare people in the world that could save that much. Well, now everyone has $10,000 in their pocket. So now your $10,000 is not worth anything because everyone has it.
Yep.
So that's basically what they did, is printing, in a way, $10,000 and give it to everyone's pocket. That's the amount of money they printed. 40% of the entire US dollars was printed in 1 year. This is a huge, and that's going to create inflation. There is no way to fight it. Whether you increase interest rate to 8%, it's not going to stop it. It's just checkmate.
It's like letting every pair of Jordans to ever come out get released on one day. You're going to find them over at TJ Maxx, Ross. There'll be so many pairs.
Burlington Coat Factory.
Yeah, you be like, hey, man, you're not going to believe this deal I just got on these Jordans. Like, man, I got those last week.
Yeah, I mean, the demand completely just goes to a completely different space. But yeah, so it's wild, man. It's really, really wild. So I'm going to acknowledge some people in the chat. I'm struggle streaming, guys. So I want to say salute to everyone that's in the chat. Salute Wally, Wealth Talk Productions. Salute Facts and the Uncomfortable Truth with Bernard S. Check out his channel. Search his channel. Bernard is a great content creator, and he has some really interesting topics that he'll be discussing here coming into the future. And I'm looking forward to everything that comes from him. We have Kareen in the chat, and she is coming, and she's just found out that she's getting ready to no longer be remote. And so, the good old collaboration initiative has also impacted her. My company had some issues with some leasing spaces, right? So now they have some leases in place, and so they want to make sure that they're satisfying the spaces in order for them to satisfy leases. So I can understand that. There's some people who are also doing 3 days a week or 3 days a month in order to satisfy the leases that are in place. Salute First Gen Corporate. He's here in the chat, and salute to you, bro. I'm looking forward to what you think about the things that Jim Cramer has suggested to be implemented in order for things to bounce back. Salute to Mr. Awesome. Mr. Awesome is here checking us out. He's doing he says he's stopping by before his 5K run. Man, you doing a 5K tonight? Jeez, man, I need to get myself in a better situation so I could do a 5K myself too, man. This pandemic weight is waning on me, man. I'm ready to to get rid of it. So First Gen Corporate had an interesting question, you all. Let's see. Let me see if I can. Here we go. He said, this is what he says right here. He says, hypothetically, for research purposes only, what should one invest in with $20,000? No crypto. Man, look at that. He's already taking shots at you guys right there, man. That's what he's saying. He says, hypothetically speaking, what would one invest $20,000? Here we go. Matter of fact, here we go. Salute, First Gen Corporate.
Hey, Simcia, can you hear me? Can everyone hear me?
Yep, we can hear you. We can hear you.
What's up, Productions, PerryUnlikely.
How's it going? First Gen Corporate, I got a question. I could be completely wrong. You ever watch Pocket Watching with JT?
Yes.
Were you up there at time when Anton Daniels on there?
Oh, that was me.
Okay, I thought it was, but I wouldn't. I thought it was, but I wasn't sure. So I remember names pretty good. So
by my grace,
wanted to check. So shout out to you, man.
Thank you. Yeah, I was just asking questions about some discrepancies that I found, and I think the results spoke for themselves. So I'm past that now. But
absolutely.
I just like hearing Simcia, Wealth Talk Productions, and you, PerryUnlikely. I know you're heavy in the crypto space. I've been ninja watching all you guys. So I love hearing financial talks. I thought, let me come to this panel and let's just have the conversation.
Absolutely, man. Absolutely. When you say with no with no crypto, I'm looking at. I mean, me personally at this point, just because I don't know, and I'm heavy into real estate as well. I'm looking at stuff like Tesla. The Amazons. I'm looking at stuff like that pretty heavy, to be honest. If we're not talking crypto, that's probably more where I would lean. Right now, until we see where the real estate market is actually going to go.
Here's another twist here. Let's say that person is looking for 3 to 5 years time horizon with outsized returns.
Let me chime in and say, again, I gotta say this is not financial advice. I'm not a financial advisor, right? With that said, me personally, let's see, 3 to 5 years, no crypto. Sheesh, that's tough. So what I would do is, so we want to pull out what I'm currently doing right now, other than crypto, is real estate. So I'm looking into lands. I'm looking into overseas. I don't like any deals right now in North America, but I'm finding some cool deals, especially projects that people are talking about creating like a whole resort next to it, like the Caribbean. With the remote economy, it has opened the door to a lot of projects in the Caribbean, hot countries like Ecuador, Costa Rica. Like I just got an email this morning about a project I was eyeballing, and it's looking good. So basically, and it's super cheap. Like that's the beauty of it. It's like super cheap. You can buy like lots of lands and basically just hold, right? Well, I bought a land like this December. I'm already up 15K on the land, and the land is like basically 55K. And I'm talking about 10,000 square feet. I haven't built anything on it. I just been paying the land. I'm already up 15K. If I would sell it back on the market, I could ask 15K more, and then I think you would sell it within a week. So that's what I would do if I'm not doing real estate. And then if you don't want to take too much risk, like I would also do business, but business is super risky. But that's the where I'm looking at right now based on my goals and my personality type. So, but man, we haven't hit the bottom yet on stock and crypto. But I would wait the bottom and I would look at tech stocks, but not the. Honestly, I wouldn't even look at the Teslas. I would look at companies that are doing gearing up for semiconductors, virtual reality, wearable glasses. This is the tech, the type of tech that kind of like the bubble that hasn't blown up yet, right? That's what I'm, because the Tesla's bubble has blown up already. Like, I was interested in Teslas in 2014 and 15, right? Not now everyone knows it. I'm like, yeah. Whenever people know things, I don't look at them anymore. I love to look at things that people haven't realized yet. So wearable glasses, I know it's going to be huge in 3-4 years, right? Huge. So I'm still undecided about the battery side, but I'm keeping my eyes open with the electric revolution we're going through right now. So I think it has another leg to go, but I'm a little bit more cautious because the first leg already happened. So I try to catch them early on, not necessarily after, but I'm a little bit cautious, but I would be interested in that too, and keeping my eyes open to see if I can find opportunities to invest in that. But I would say, but yeah, tech stocks, but wearable, man, metaverse, gamings, things like that. They have another leg to go up on, and they haven't blown up yet. So there is some good rooms to make some money there. But anyway, again, not financial advice. This is me personally, what I'm doing, and we go from there.
Yeah. So and I'm along those same lines. This is just information, right? So, for me, something that's been really like heavy on my mind is when we look at companies like, oh man, I can't remember the name of the company. I think Wealth Engineering spoke on it. It's a company that starts with the letter M. I looked them up, but it's the company that makes Insta360, right? And what they do is they're involved in. They have that Matterport. That's the name of it, Matterport, right?
Yeah.
They have the 3D scanners. They have the 3D scanners that they use for real estate. So what it does is it can capture a whole room. It costs about $4,000 for that. That's like an industry level product, right? But then they have a consumer level product, which is the Insta360, which is a 360 degree camera, right? But what I believe that they're actually doing is they're actually capturing information the same way Tesla cars are actually capturing data, like road data. They're actually capturing data in our world all around us, right? And what they're going to be doing is they're going to be selling it to these augmented reality providers, or they're going to be selling it to or feeding it to the Facebooks or the Meta of the world. So you can just look at it like that. You see the partnership that happened with Facebook and Ray-Ban, and those glasses that they have are also data acquisition tools as well. Don't believe that they just have them just to have them. They're using them in order for them to scan the environment so they can have an idea of what's out there. It's literally like those things are soldiers out there doing work. Those are the things that I've been paying attention to, and I'd be curious to see what those companies are doing. Let's see real quick if we could look it up. But I'd be interested to see how these companies are doing, because I believe that these are things that we should be paying attention to, because if you really pay attention, there's not a whole lot of conversations that are happening with these companies right now. Like right now, it's like in the early stages.
Yeah, and that's when they're cheaper, man. And let's say you didn't know the timing, because me, like I said, I learned how to understand the bottom. But let's say you didn't have time to do all that. Well, that's where dollar cost average is a great strategy. Let's say you identified a couple of industries, niche, that you wanted to focus on, and then you had 20K, for example. You don't know exactly when the best timing is to load up on all that 20K. Well, hey, maybe you start $100 a week on the same stock every week, and then when you do find the best timing for you, you might want to add more. But if not, just keep on that and load up on the positions, and it's the best thing to do, especially when the market is going down like that. Like any news, like for example, tomorrow we might have a news from the government that might decide, or the Federal Reserve, that might trigger a drop, right? So we could get that. So things like this is the best timing when we have high volatility to dollar cost average, and then when things are going sideways, then you load up. But that's what I do. But the best thing you can do right now is to research, identify a couple of opportunities that you're willing to hold and invest in for the next 5 years, and then load up. Me, I've been shopping. I've been doing this work since last year. since last year. The profit that I made on crypto last year, I didn't buy it last year. I bought it like 2 years ago, 3 years ago, right? And then I sold it last year. So and then after I was selling it, I always do this work. Where else am I going to put that money? And I was doing my shopping list, but I didn't buy anything yet. I was starting to do the real estate, but I didn't buy any stocks and crypto yet. I was waiting for what we're currently seeing right now, the dips. And then slowly dollar cost average my way in. But when the big drop downs, that's when I'm going to the 1% strategies where you buy things at a discount with a huge smile on your face and wait for it to start turning around again. But anyway, I hope that answers your question, Ferguson.
No, thank you all on the panel. Can you hear me? Just want to make sure.
Yeah.
Thank you all on the panel for again. This is not financial advice, everyone. This is just for information and entertainment purposes only.
Exactly.
Invest in your own risk. Talk to your financial professionals, etc., etc. Yeah.
Yeah.
So
He knows his feel.
the one thing that kind of concerns me about the U.S. because I study economics and study like economic history, things like that, and my free time. This country hasn't really seen a real recession in maybe 14 years at this point since the Great Recession.
Mm-hmm.
You know, it's been QE for the last decade, easy money policies all around. So everyone's got rich and everyone's gotten used to low rates for 10 plus years.
Yep.
So now we hit a pandemic which engineered a recession, but you're going to recover from that. And now, I mean, even though the stocks are down, let's say 20 about 20% in the S&P 500, you're still way ahead than you were even 2 years ago, pre-pandemic. So back in my mind, I'm like, okay, this inflation thing has gone out of hand, right? The Fed has to do some tightening. However, because the country has been in this easy money, been lulled to sleep for the past 10 years, I don't know how that is really going to impact our country. Like, I'm thinking we're probably going to go into recession soon. And if so we make it out the recession, could we double dip? Because this was happening in the 70s. There was a double dip. There was like 2 recessions. Right, first you had the oil shock supply, and then you had another one towards the latter part of the 70s.
Mm-hmm.
So that's my biggest worry when the government got out the gold standard and all that, is that we get out of this recession, we think we hit the bottom, and then inflation keeps on spiraling out of control. Like I think you mentioned wealth talk. You mentioned about the wheat prices and the commodities. That's a real issue because there could be like some worldwide hunger, right, in some developing nations. And to me, that's extremely concerning. The Russian conflict is also extremely concerning, considering that a lot of wheat and oil come from those countries. So even the supply chain.
Did you notice that they banned exportation to other countries? Like,
I'm telling you, it's crazy. Like, they're not paying attention to these conflicts. Like, these conflicts really affect you more than, especially the one in Russia. It really affects us more than other conflicts because we're huge trade partners for certain goods that we're relying on them. And it concerns me that this inflation is not going to be able to get under control. People are spending like crazy. And no one seems to care about this. It's really weird. Except for you guys. You guys care about this.
Yeah, that's my fear too. I think people have been lulled to sleep. I mean, nobody's talking about it. I mean, really at all. And I think it's going to get nasty. That's why I was saying I think we should have just bit the bullet and let things. I mean, at some point, there's going to have to be where the strong survive. I mean, it's going to have to be. And not to mention, I mean, obviously, not to make it political, but when you do continue to, send money elsewhere, it just continues to add on to it. It continues to add on to it. So it's, just the Fed and from a government standpoint, period, it's like they have a checkbook to spend and it doesn't, they always talk about balancing the budget. They're not even looking at the budget. There is no budget, frankly, just spend whatever. And it's gotten out of control. And we've had the discussion about, America falling off as the, as far as with the world's reserve currency. And, look, this is the time where something has to pull through or get turned around. But frankly, his tool belt, there's no more tools on the belt. He's used them. He's used all the tools he's got. So I definitely think it's going to get worse. No doubt about it.
Hey, quick question. What do we think about China? Because I was researching, China is competing to be a superpower. It's amazing. About 40 years ago, they saw a calculator and it was amazing to them. But now they're passing us the technology, right? And they have a lot of rival companies, like LinkedIn left China. A whole slew of American companies just exited China because the homegrown competitors are just too strong to compete against. So I'm thinking that, and believe China is underweighted in the stock indices. So I'm thinking China might be actually a good investment going forward. If you were to invest in stocks, maybe allocate a portion into China ETFs.
Well, I mean, you're kind of like forcing me to dropping gems, but these are the gems I normally teach my course and my exclusive Discord. But I'll just give you a highlight. One of the things I do is I follow trend. There are trends that are 5 to 8 years. There are trends that are 30 years. There are trends that are 90 years, and there are trends that are 500 years. Now, to keep it shortly, a lot of this trend that I'm just noticing is showing me the trend that Western societies are going low and the Eastern societies are going high. So when I do say I'm looking for real estate, I'm not just looking at real estate. I'm looking at other types of investments too. And a lot of that, especially in my retirement portfolio right now, that's where a lot of I'm only investing, and not in China per se only, but Asia in general, because you can find a lot of good deals too in Taiwan, for example, right? You can find a lot of good deals there too if you look. But I that's what I do, man. That's what I do. I love buying valuable assets undervalued, right? Valuable asset undervalued. And the best way to do it is to be ahead of the game and understand where the trend is going, and then you get there before the masses. That's the best way to find deals. And yeah, so real estate is one of them, stocks, and you can talk with a mortgage that can a broker that can not a mortgage broker, talk with a broker that can allow you to open an account there, or maybe do it on their behalf. But there's different way to approach those markets. But yeah, man, I'm doing that on the side too. Like, I don't talk a lot about that, but yeah, yes, not necessarily just China, but Asia in general. There's lots of deals, man. Lots of deals, lots of opportunities, undervalues. They're hungry for growth, and their stocks are like on the floor, man. They're waiting for investments. So I'm here.
I think West Africa might be a good investment too. Now, if we're talking about emerging markets, it's an entire West Africa, right? East Africa is a little different. I think West
Yeah,
Africa is just ripe for just supercharged development. You got a
yeah.
large English speaking population. There's not as much wars over there. Government's kind of stable. I mean, that's just a background way to get tapped into.
For now, did have this couple streams on that on my channel already. For to keep it short, it's a different market, right? It depends on the market. Like, I wouldn't recommend try to go on the African stock market, for example. No, that's not what I would do. But however, if you're looking for businesses opportunities where you can bring your own team, your own marketing team, your own operational team, and then you use the lands, the resources available in Africa, you can use that. Man, you're good. Like, now is the time to do it. Right now is the time to do it. It was the time to do it like 2 years ago. Like, to be honest with you, another project that I'm doing right now with and I'm talking about that too on my Discord, is I'm looking into Ghana right now. I'm looking in Ghana, I'm looking in Nigeria, and then there's some 20,000. Let's just say this: $20,000 in Ghana would go a long way for a business. And if you're on the right niche, you will make your returns fast, very fast on that. So it's not necessarily just the stock market, but this is where we're getting into wealth engineering, and then looking at different markets. Like, if you had one capital and you're looking at business, stocks, crypto, real estate, where do you want to put the money? Which market do you approach first? And then all that, and that depends on the best timing how fast you want to get this return, how much you want to do it, and then your long-term plan. But if you can kind of like see the macro aspect, see where the trend is going, and then do the move ahead of the game before everybody else, yeah, you're good. So that's basically the whole concept of wealth engineering.
I just want to add real quick. With China, I was thinking China kind of a good area as well, but just the Evergrande thing, as far as, and I haven't read up on it lately. I'm not sure if, I know the concerns are still there, but how that's coming about. And I don't know how ugly that's going to, I don't know how ugly that's going to get overall. But yeah, I definitely think international markets are definitely looking better from a value perspective than the U.S. at this point.
Oh yeah,
no doubt about it.
All right, guys, give me a second. Let me acknowledge some people in the chat. So I want to say salute to Titanium. Thank you for coming through. Appreciate you coming through. We have Mr. Peter Investor Am. Salute to you for coming through. Appreciate you coming through. We know Peter Investor Am always has those good questions. So
yeah, shout out to Peter Investor Am.
Speaking of questions, this is what he was saying in response to the unofficial information we just spoke on. He says, what about AI, cloud computing, drone technology? So this is the space that we're going into. We have people who are heavy in the tech space, like Tam. Excuse me, hold on, let me fix this. We have people who are. Hold on, guys. Let me
struggle streaming already.
Straight up, right? Anyway, we have people like Tam from Women in Linux who are speaking about the technology that's coming down the pipe. So she can speak to AI, she can speak to cloud computing, she can speak to quantum computing, she can speak to the space race and all the opportunities that are happening, that are going into the future. That's what I really appreciate about people who are heavily engrossed into this space, because it allows them to really speak from a position of authority about the things that are coming down the pipe in technology. So, check out Women in Linux and take a look at the Tech Stocks and Jobs show that she has on Saturdays, where she speaks about a lot of the things that are happening in technology and in the marketplace overall. So here we go. Speaking of Peter Investor Am, here we go right here, right? It says, which is better, buying company stocks at a discount or buying an asset for the greatest return on capital? So tell me what you think. Wealth engineering. We'll start with you.
All right. Better buying company stock at a discount or buying an assets for greater return on capital? Well, to me, it's kind of like the same thing. A stock is a company that you buy, which is an asset that can give you a return on capital. So, but to give more insight on this question, what I would say is what's always better is the cash flow value investing. And that's in my opinion. My personal opinion is to buy an asset, whether it's stocks, whether it's a business, whether it's real estate, that can pay you now and then pays you over time. Like, to me, this is the best way to play the game. Now, if you manage to get this asset at extremely low price on the right timing, and then you ride it all the way up as it gains appreciation, let's say 3, 5 years, 10 years, it's just beautiful master play of playing this game. But to me, it's the most efficient way to build wealth. The cash flow that you're collecting on a maybe quarter, maybe monthly, maybe daily, maybe weekly basis is encouraging you to hold it more. And then the holder you hold it, the more appreciation you get. But you only get the appreciation if you buy it at the right time. Because if you do buy that same asset at the wrong time, at the top of the market, well, it's depreciation. So you may get the cash flow, but it's still depreciation. So you might have to hold it longer to get just even on your money. So this is rough. This is a rough battle to play. So that's what I do is I time the market and I look at the location. I looked at the markets. And if I don't see what I want in North America, I'm going to look elsewhere. But I love to get it at the bottom, ride it to the top, I did that with crypto, take my profit off crypto, and which market should I go next? Oh, real estate is good. Oh, overseas market is good. And I try to buy it low and I'm riding it on the top and try to make cash flow along the way. So that's how I play the game. To me, that's what's better. Again, different people have different opinion about that, but at the end of the day, you have to match a strategy based on your own personality, and then that's what's going to help you stay consistent on that and discipline on that. And then make sure you limit risk, buy low, sell high, or buy low, hold, regardless of which strategy you want. But go with that. Go with and you were talking about AI, cloud computing. Definitely agree. Text in general will go well. Drone is a little bit more risky for me because it can go so many ways. It's still early. I especially in recession, I like to go with infrastructures, with fundamentals, right? With platforms that people need to build upon on, right? So instead of looking at drones, I would look at AI. I would look at the data centers, right? I would look at electricity, right? Some energy. I would look at the infrastructure that they need to get the drones working. It's a much safer way to still be exposed to the appreciation that drone might get. And then when we get closer to the end of the recession and starting the next bear market, then I'm starting to gamble a little bit on drones. But my foundation is already built, and I'm setting up to win regardless of how the market plays. And ideally, that's what I preach: is try to make money regardless of which direction the market goes. And one of the best way to do that is invest in foundation, things that people need regardless of the market.
And what about you, PerryUnlikely? What's your thought on his question?
I was kind of in the same boat when I was kind of thinking it's kind of the same thing, but I guess it could be, and it may not be. So I do a lot of the same in terms of, I like to look at these markets. I'm just an opportunist, right? So although my channel is about crypto, think about it. And I told you guys even before we started the stream, I bought some land in that metaverse. What I knew though was Ethereum is extremely expensive. Traditionally, at this point, people who deal in Ethereum a good amount, they got some money because it's just not cheap to deal with. So what I knew is by converting that Ethereum, and Ethereum was probably $3,000. It was $1,000 more at that point. By converting that to this metaverse land, because the metaverse, because Bored Ape Yacht Club is so expensive, I knew that it may drop, but a lot of these people have, an NFT that's worth 400, 500,000. They're not concerned about that land dropping. So I just knew overall that price floor, I don't have to worry about it getting away from me. So actually by converting that over, I've turned out better than holding, I still hold Ethereum, but the land I bought with that Ethereum is holding up better than the actual Ethereum. So even for me in that case, it was a move, the same way we move money into assets. Well, I moved that into an asset, although it just happens to be, an NFT or crypto. But I've obviously done a lot of research on that most people just aren't into NFTs. But I just wanted to reference that because I do the same thing even in crypto. I'm looking for, I stake some crypto, but there's times when, I like to stake because I always want my return. But if I see an opportunity and I need to unstake it, provided it's an easy one to take an opportunity, then boom, I'm always going to keep it moving. And that's obviously looking at tax implications. I mean, you got to pay attention to that. So, I like to bounce back in between the market. But one lesson that I have learned is, and it just can take some years to learn, I'm a lot more conservative than I used to be. There was a time when I was, I would say 2020, late 2020, I probably was making more, and I was able to probably make more in crypto in 4 months than I'm making a year. And I was just like, when you kind of get that rush, you're like, man, this thing is just going to keep on going up. But you have to temper it. And I even tempered my expectations, but still in all, I still could have probably done a better job of taking some off the table. But, it is what it is. Like I said, I'm still up, but just kind of learning, because you gotta manage emotions in crypto. You got to manage it because like I said, it's some of the fastest money I've ever seen come. So, but anyway, really just getting down to it, it comes down to, I like to bounce in between the different assets. For me, real estate is just out there right now. And I'm just not, I mean, it's all about your market, right? But so I'm in Atlanta. These prices, man, geez, they're just, I mean, I don't know any home in Metro Atlanta that hasn't gone up. Maybe by at least in the past 10 years, it hasn't gone up by 120%. I mean, if it's in a decent place, 125, 150%. To buy into that right now is something I just myself don't want to do. So I'm looking for, unless it's some type of off market deal, some type of deal where I know I can force some appreciation. So I think right now is a tricky time, which gets us back to the subject of this show. I really think if there ever was a time the dollar cost average, it's right now. Until you figure out, until we see something drop. This is the best time the dollar cost average. And I'm like wealth engineering. I dollar cost average, but man, when I see an opportunity,
you got to stash.
I run right from it, man. And I'll throw a nice little lump sum down on something. But what I have taught myself to do is continue to dollar cost average a little bit, just a little bit, so I can still stay in that mind frame. But I will take some lump sums and put them here and there. So
maybe that's something that we should really talk about too. How many stashes should you have? Like, should you have like the stashes for like your everyday wear? Like, all right, let me just for my regular stuff.
Yeah. Actually, I keep. So here's how I do it, man. In terms of crypto, well, I do have some just regular savings, right? Just what I do, man. I call you're supposed to have your emergency fund.
Yeah.
So I keep that. That's just something I keep on the side just because I just need it. And that's about the only real cash I'm going to have. Then I may keep a little, and I'll go over and beyond that for real estate, waiting for something just for that. And then as far as like crypto, I hold some crypto that I do not touch. I keep some to trade, just to do a little bit of trading. I don't day trade, but to do some swing trades, some stuff like that. And then I'll usually keep two separate wallets with a nice little lump sum just to go in on something. But I'll recycle every once in a while. I'm like, okay, I need to get rid of these 4. They're hanging out there. They've done okay. It's time to kind of move those back into something else. So I kind of do that. So I do keep, overall 5-6 little pockets of money to do different stuff with, but they've each got their intention, and I don't really mix and mingle. I just work with what I've got. That way I can keep track of what's actually working, because just like wash trading, a lot of people say they're making money in crypto, but man, at the end of the year, they ain't made nothing. They're where they started. They took L's, they got some W's, but they end up in the same spot. So I do try to keep up with it because I want to know exactly what's working and what's not. And there was a time when I was so-called trading, it wasn't doing nothing. So I stopped doing it until I found out what the hell I was doing, and then started actually doing a couple of trades, here and there, just small ones, just basic technical analysis, nothing crazy. So
first gen corporate, what do you think about what he's saying? What's your take on it?
I'm trying to make as much money as possible. So I don't mind. So this is where I defer. I agree with PerryUnlikely. Like, I keep an emergency fund, and because of the industry I work in, I keep a larger emergency fund than necessary than most people probably have. But honestly, to be honest, like that feeling of going to sleep at night, knowing like, listen, if something happened, I don't have to worry for an extended period of time. That is so priceless to me.
It is priceless.
So even though people say cash is trash and all those type of things, like, listen, I'm gonna keep that money in a savings account. Don't think about touching it at all. Maybe add to it my expenses if I see my expenses going up. And just keep it there so I can go to sleep at night and not worry about, did I complete a file on time or something like that. Like, you know what, you get rid of me, I'll find something else. So that's one thing. The emergency fund is so important. But other than that, right now, I'm saving up because I do believe we're gonna, we haven't hit the bottom yet, and I recently took a large amount of cash and I invested it into an asset, into a stock, and I still have some cash left over. So now I'm saying, okay, where am I going to take the rest of this cash and invest it? Am I going to wait to time the bottom, which I don't think we hit yet, and try to like go into like some large cap like QQQ or maybe like the Russell 2000 because those do really well in recovery periods. We have to time that perfectly. But in the long term, they don't do as well as S&P. But in the short term, you can get a greater return on your money from a downturn. So I'm more into the assets, but more importantly, the greatest asset is yourself. So I'm always going to bet on black. So that's just me in general. I do understand the perspective on that cash on cash return, and I haven't felt that yet because I'm more like my money, most of it honestly is locked up. I don't even plan on touching it. I just kind of invest it and forget about it. Like, listen, I'm not gonna look back here until 5-10 years, because I really don't need the money. Like I said, once I had that large emergency fund, I was like, everything else can be invested into long term. I'm really looking for purely just profit maximization. I'm looking for like those events, like that big event, like something like Crip, right? You hit a 10x, it's hit another 10x, right? That's the type of events I'm looking for. So listen, I can wait 10 years, right? I don't need the money now. Just wait 10 years, give me the event, and then if I have enough, then I could probably retire early and do something else in my life. So that's just me in particular. I'm all about that profit maximization. I take that very seriously. I'll throw as much cash as I need on something. I can wait. I'm patient. I've been broke most of my life, so I don't mind living that way for a couple more years.
Yeah, I just wanted to add very quickly on what you said earlier, man. Like, it's so true. This is something I experienced really a year and a half ago, man. Like, just to have like I finally achieved 6 months of my saving, but like all expenses paid, right? And man, the peace of mind that you get, it's something that people can talk about, but you have to experience it to realize. Now, there are some risks that I'm taking that I would have never take if I didn't have that cushion back there, right? Like, whether it's business, whether it's some games, cryptos. And let me tell you, I took some risk last year, man. The DeFi, decentralized finance, basically there's no one teaching DeFi, basically. So I had to learn by trial and error. And I made a lot of mistakes trying different things and learning along the way. But I would do some of these risks, I would never have done it if I didn't have that cushion, that I know that regardless of what happened, I still have that. I can survive. If I lose my job and my investment, I still have that. And man, it was a peace of mind, and I definitely recommend people to try to get that, because it will change your perception on how you approach the market too. And the more risk you take, the higher the rewards. And me, if you're the type of guy like me who wants to make minimum 10x, then it's you need to have a good foundation that allows you to get there.
Yeah, I agree. I just want to add to that because I'm the same way, right? And I think also, man, well, just the friction, right? The friction that exists in corporate America anyway. It also, people talk about FU money. I mean, I'm not even talking about that. I'm just talking about in my day-to-day decision making, it just keeps you in a place where you can literally say, nope, not going to do that. I mean, if I need to, no, not going to do it, move on. No hard feelings. And that's just a better space to operate in anyway. You don't need to be operating, and so many of us do, unfortunately, because I'm still blown away when I see those statistics about, I forget the percentage that don't even have, it's like $500 or $1,000. Like, people can't even fix a flat tire. And I just remember being in that space, and it's just a blessing. I mean, if I pop 4 tires, man, I don't want to, but I'm gonna throw 4 tires on and just keep on moving. And it's just a blessing. So you can operate a lot better. And like you said, man, you sleep at night a lot better. And I agree with wealth engineering also. I'll take a little more risk as well, because I know I've got that stash. So I just take a little more risk as well, just on the end of, being able to kind of reach, here or there. But in terms of, for me, and I know I revert back to crypto so much just because I just know it so well. But what I would urge anyone who like, there's investments, right? But what I would urge anyone that, even if it's a small amount, even if it were 5,000, 10,000, you look at some of these, and wealth engineering may have a different take. If I do look at Cardano, right, and I'm just using that because of the technology and the long-term look, the prices it's already reached, even if it got back to where it was at, it's a 6X today, if it got back to where it was at. When I look at some things like that, anyone willing to put up 10,000 or something like that, 5,000, 10,000, just the numbers are just ridiculous. I mean, like I said, that was the game changer when you see something go from 3 cents to $3. It's just it's a game changer. And I think that's probably the best investment. That is probably at this point the best investment I've ever made. That particular one. I think I've got some other Ethereum as well, but ultimately, yeah, even for people that aren't heavy into crypto, a little bit set along on one of these projects that's been around and you can already see how high it's went. I don't want to say it's guaranteed, but it's just a good bet. And even as I stay in the market, I do tend, in times like this, I am less risky. I'm just not as risky. I'll put a little bit in a project, let it float. But as far as any stash, I just keep it in a more restricted, just to see where things are going. So I just wanted to add that. But yeah, they say cash is trash. Well, peace of mind is worth it. That's the counterbalance. So
can't put no price on it. So I wanted to speak to something that you actually said, and then we'll get to this emergency fund value.
There's also the question from Peter Investor. I want to chime in too. So
okay.
Let's not forget that one too.
No. So what I liked about what PerryUnlikely said earlier that's really key is that he said that Ethereum. He said the value of Ethereum is pretty much being hedged by his stake in his metaverse property, right? So by him having his money invested on that property, it has no option but to go up, Whereas Ethereum is going to be a more cyclical type of relationship. But as more and more people migrate into that environment, that value of that stake is going to continue to increase. And so I think there's tremendous value in that because I don't know how that compares to staking, like the experience of staking compared to you actually making that move to use Ethereum in order for you to purchase that property on the metaverse.
And yeah, and let me add this real fast because the concept behind that, look, a lot of NFTs are straight trash. I mean, there's just no doubt about it. But when you look at this particular ecosystem, a Bored Ape, which you could have got for $200 at one point, $192 or something, becoming worth, probably the floor right now, maybe 300 grand, 350. And then they've given out mutant apes. There's like 3 more, the Kennel Club, the chemistry set, there's just so much to it. Ape, the ape coin. And it's crazy because I tell people, man, I hate even mentioning ape coin to someone. It just sounds funny. Like, hey, buy some ape coin. It's just crazy. It doesn't make any sense. But when you look at all that's come from that, and then you think about the branding is as strong as is just freaking strong. It's as strong as it gets. They've locked up Hollywood trilogy for 3 movies. So when you look at all that and you think about this metaverse is a game also, it's going to be a game. And you think about, so you got an opportunity to, from an ecosystem, because those people that own the apes, I bought in on mine, but those people who own the apes actually got a free piece of land. So they got a free piece of the land and all the other stuff. But when you think about the fact that this game that people will play, and I think it's supposed to be, it'll be the first time where literally I think over 10 or 15,000 people can simultaneously play in one location. So it's even advancing gaming, but thinking about you owning the land in this ecosystem that everyone plays on, it's just to me, it was just a no-brainer. So that's why I just continue as it gets cheaper to buy it up. And I personally think there'll be a day when the land is worth more than the apes, or around there. I don't know. I can't confirm that, but ultimately, yeah, I think it'll work out. These are rough times right after the launch, so it's kind of been slightly devalued. But in July they're coming out with the demo. So as the excitement comes out and they start to roll stuff out, that's why I bought 2 pieces. One piece to keep to get those things that they give you down the road, and then one piece if I want to sell it, I can profit off the one piece and go back into Ethereum, and there you have it. So yeah, so I even hedge my bets that way. Absolutely.
So what I want to do is I want to go back to what Peter Investor M. I don't know if I think this is the second question. Excuse me. Let me fix the video. Oh, actually, before we go there, hold on. Before we go there, we are struggle streaming. All right, hold on. Before we go there, we're gonna go here real quick. All right. So that value that you were speaking to, PerryUnlikely, is, I don't know, it's kind of confusing because I'm seeing 2 different numbers. One says it's 49% in 2020. He said the figure is down from 54%, but notably improved from 44%. So this value is saying it's between these two or something. I don't know. But up here, what Bankrate.com is saying is 23% of people actually have enough. It's reported based upon telephone interviews that more than 1,000 people revealed that just 23% of Americans have emergency fund to cover 6 months of expenses, and that's literally like flying without a parachute, without a doubt, and we're going to see, because if we go back to my man over here, and he's saying, people need to spend their pandemic savings so they are motivated to go back to work, according to him.
I can't even.
So we're talking about them spending that money, but at the same time, only 23% have the emergency fund. Matter of fact, that money should have been serving as a temporary emergency fund, not this business right here. Come on, man. So it's not. It smells like nothing but a setup, but
Yeah, man.
What do I know, right? All right. So now we're gonna move to what Peter Investor M spoke on, because this guy, I don't know what's up with him. He's like, he sits up here. We're gonna say he's probably one of the most intellectual investment guys out here on the space.
Yeah, hey, man, I love his questions, man. He's
he's always got good questions,
thought-provoking questions. But I think he was adding more to his
Context,
first question,
right? Yeah,
when he was asking the capital ROI versus a stock and investment. So me, the way now the instinct response to that would be go with the higher return, right? That's the first instinct response. But wait, I want you to actually do some critical thinking on that. You get something at 50% discount and you get a 10% return, versus doing 10% discount but get 50% return. Now, it all depends on how much cash do you have initially. Because think about it. Let's say we're talking about $1 million cash, right? And you're buying a stock at $1. you get 50% of that. That's 50 cents, right? So your $1 million can buy basically twice the amount. So 10% of that, it's still a lot of money. So we're talking about 2 million, 10%, 200,000. That's good, right? If you're making that a year, why not? So that's what I'm saying. It all depends on how much cash you really have and what's your goal. So initially, everyone would say, man, let's go with the higher return. But you might be in a scenario where you have a lot of cash, and maybe the higher return is not necessarily the safest thing to do. Maybe it's the lower return but consistent growth is the better thing to do. So I just wanted to kind of like give that feedback to say that, hey, it really depends, right? Because 50% discount, if you're buying a dividend paying stock, right, at a 50% discount, and then that pays you, let's say, 10%, when you include the price appreciation plus the dividend, it's me personally, that's something that I would go for because I'm all about cash flow value investing, right? I love the cash flow. So it really depends on what is your goal, what is so I just wanted to provide that, but most people would go for the faster return, right? 10% discount is still a discount, and then 50% return, well, that's almost half of your that's almost like twice your money, right? So definitely you can never go wrong with more profit.
I agree. I agree. I mean, it just depends how big your shovel is, you know. That's really going to help you determine which one makes the most sense. But, you know, along the lines of what PerryUnlikely said, right? I'm almost curious, Perry, with when you see something that goes from being 3 cents, or I don't know if you said, did you say 30 cents to $3? Which one?
Yeah,
$3.30.
Yeah, 3 cent. I saw it go from, I was in it when it went from 3 cent up to $3, and now it's back down to, it's back down to
50 cents.
50 cent now. Yeah, 51 cent, 52 cent.
Yeah, so I'd almost say that experience, that high that you experience going from that value up to 3, I mean, it's like you start chasing it. It's like, oh man, I want some more. I want some more of that, you know?
Yeah, it is. I mean, man. Yeah, it is, because you're looking at I want to say initially what would have probably been, you're looking at $1,200 going to 120 grand. I mean, that's just, and that's like I said, I kind of saw it on the way up, and it's funny looking back. And I remember times when I was like, man, 15 cent, it's getting a little high. I don't know if I want to buy in anymore. Because that was initially right. And then now looking back, I'm like, man, I thought 15 cent was high. And when they run, they just run. So that's why I encourage even people that don't know crypto. Like I said, when I initially started, I didn't know a lot about crypto to begin with. I mean, I started out buying Bitcoin, but it's just the sheer thing of, I just literally looked at the charts and saw what it had done. That's why, like, if Bitcoin dropped to 2 grand, you would have people like, oh, I better not buy that. I'll do anything. I'm going to get a hold of it. I don't have to question nothing. I'm getting my hands on it, because it will get back to 68,000 and beyond at some point.
At least 10 Bitcoin if it goes to 2,000.
Oh, absolutely. And no question asked about it. It's just a time thing, right? It's just a time thing. So, yeah, that's the way I look at it. And with adoption continuing. So, but yeah, there's definitely a high there. Another one was VeChain. I bought that. It was like 0.0006 or something.
You put $1,000. You put a couple of 100 in, and gives
like, and that one went up. I want to say that one went as high as 28 cent. So, and I bought it. It wasn't even at a penny yet. So, when you see that, it just, man, but to that point, I'm someone in the market all the time, and I've had people that don't know flip about the market get in one I would not touch with a 10-foot pole and turn 2 grand to 200 grand. It's just, but I don't tell people not to do it, because I know the possibilities. I'd be like, hey, be careful. And that's what happens in crypto. You tell somebody about it, they get excited, and then they come back. You tell them something that's a good project, they come back and they're like, oh, I just bought this. And you're like, why did you buy that? I did not say anything about that project. But, people kind of go down their own path. But yeah, there's definitely a high there that you have to teach yourself about. And I can remember almost every drop, whether it was May 2021. I remember sitting around on a Sunday, like, and this whole time I've been up, right? Because I bought so early, but it's still like, I should have took that profit off the table, but it'll come back. And sure enough, it did to a degree. So, you live and you learn. But the biggest thing I understand is though we'll see those prices again, ever since then I've started doing the opposite of what everybody else is doing. When people literally, if I go to the barbershop and they're like, yo, man, I just bought me some crypto, and it's somebody that knows nothing about crypto, I'm selling. I'm out. Yep. I'm not even, you just kind of know, you do the opposite of what other people are doing. And that's really how you survive.
Yeah, man, absolutely, man, and absolutely. Only 10% people really make money on the market, and these 10% of people are taking the money from the 90%, and the only thing they're doing is doing the opposite. So me, I had to train myself to be a contrarian and to be excited when prices are going low. So that's the
Right.
thing. It requires a training, a mental training of yourself, because normally your instinct is you see the price going low and you get emotionally shocked by it. You get hurt by it. You're like you fear is coming out. So I had to train myself slowly to, and nothing helps you more in this training than crypto, man.
Oh,
If
it does it does prepare
if
you.
you survive from bear market to bull, going back to bear market again, man, the amount of emotional control you have developed is worth years and years of trading. It's like years and years of emotional control skills that you have learned in just a couple years when you are in cryptocurrencies, man. So I've seen these too, man. Hey, I not, it wasn't my portfolio, but someone I know invested in Shiba, man, back in the day. And then 3,000, man, $3,000. We saw it gone up within 2 days from 3,000 to freaking 800,000. But man, at that time, this guy was greedy. He was like, "It's gonna go to 1 million. I'm not selling any of them, until it go to 1 million." And it crashed down from 800,000 to 400, and then he didn't even sell it, and then he sold it at 200. But he still made 200,000 off 3,000 initial investment, and we're talking about it only took for 3 months for it to do that. So, imagine the emotional rise that you're dealing with in a market like this, and it teaches you a lot of money. After you sell it at 200, now you're going to reflect for the entire life. Man, I should have sold at 800.
Yeah.
It's just funny, man. It's just funny. But hey, that wasn't me. That wasn't me. But someone I know. It was just, yeah, I was watching his portfolio with him. It was just funny, man.
I still believe real estate, and I know most crypto people won't say this. I still believe real estate to be the best investment ever, in my opinion. I just do, because I can do everything with it. I can do everything with it. I can buy the I can buy the rental property, and it's being paid off on. At the same time, I can take those profits and buy whatever else, what other investment we're talking about. I can buy. I mean, I can buy other assets with it. So while at the same time it's being paid down on, and it's physical. And regardless of how many techie things we come up with, which are advancements, you got to lay your head somewhere. Now, who knows? Now they may come up with some, I don't know. They may one day come out with, some little chamber that does everything real estate does. But, for the past 1,500 years, that's been working. And, so I just feel like, hey, that's always the play. And that's the way I like to work it. So I still am real estate first. And non-conventional real estate as well. I'm telling you, trailer parks, man, is where it's at.
Heavy.
It's where it's at.
Cash cow. Yeah. Maybe we will be living in pods, maybe like
Right.
something like a storage unit or something. You go in the pod, and matter of fact,
3D printed long houses and wigwams.
So you ever seen the movie Elysium?
Yeah.
Yeah.
Elysium, the people go, like, whenever they have an illness, they go in the pod, and the pod comes through and regenerates any ailments.
Oh, bro.
And back to square one, So we're going to talk about the contrarian investing. This is what you were just speaking to. Contrarian investing is an investing style in which investors purposely go against prevailing market trends by selling when others are buying, and buying when most investors are selling. Berkshire Hathaway chair and CEO Warren Buffett is a famous contrarian investor, right? Contrarian investors believe that people who say the market is going up do so only when they are fully invested and have no other purchasing power. At this point, the market is at its peak. When people predict a downturn, they have already sold out. And, so it's just really interesting, and I think that, what this guy right here, Jim Cramer, is speaking to is he's already probably hedging against a position that he's already taking by making those statements. So I think it's really interesting whenever you see stuff like that happens. I don't believe none of it, honestly. It says let's talk about the key takeaways real quick. It said it's investing in an investment strategy that involves bucking against existing market trends to generate profits. It says the idea is that markets are subject to herding behavior augmented by fear and greed, making markets periodically over and underpriced. The contrarian sees buying opportunities in stocks that are currently selling for below their intrinsic value. Being a contrarian can be rewarding, but it's often a risky strategy that may take a long period of time to pay off. Another drawback associated with being a contrarian investor is that is the need to spend a good deal of time researching stocks to find undervalued opportunities. So this is speaking exactly to what you all are speaking to and observing in the crypto space. And so this is valuable information, and I think they're just key points for people to really understand how people are going about positioning themselves.
Yeah, it's a different style of investing. Me, I love it. It's actually the 1.5 of what cash flow value investing is. To be honest with you, you know what cash flow value? I label that term. I don't know if it exists before that, but cash flow value investing is, it's basically the contrarian methods where I buy what everyone is selling, but not everything. I buy exactly a specific niche based on a trend that I follow, and then the reason why I'm okay to hold it long term is because I also make sure that I buy things that I can pay me every day or every month. Basically, that I'm getting some dividend interest out of it, right? So that's how I kind of like fight the urge of wanting to sell it quick, because as you read, it's a long term strategy. It may require a long time before it can be beneficial. So how do I kind of like withstand this long time before you actually get the massive profit at the end, is by collecting the cash flow in between dividends. If we're doing staking, I collect cryptos. So that's I love this strategy, but it requires a lot of time. It requires a lot of research. Me, last year I spent a $16,000 on research alone. This year I'm already at 5,000, and I'm probably going to get more by the end of the year. So I still have all my accounts from last year too. So I always like take information wherever I can get it, and I'm talking about detailed research information from the market, macroeconomic, super detailed on cryptocurrencies, stocks, industries, and tech. So I read a lot about that, and I share that in my groups too. But I'm always obsessed with acquiring information, but it's not for everyone, right? If that's not the right for you, then a better way to deal with that and to limit your risk, still maximize your return, is the dollar cost average. Regardless if it goes up, it goes down, you still end up having a nice average. And over time, you also develop a lower cost when it comes to your average cost. And this is what determines your profit, right? It's going to be your average cost based on the current price right now, and the margin in between is your profit. So that's basically how you can calculate that. If you over time, it always goes on the upside, right? Even if we may have a recession, it might last 3, 4, 5 years, but on the long term, it's going to correct itself and it's going to be on the uptrend again. Because why? It's an asset. Asset is gaining value. So that's the main concept of it. You just have to picture in your mind your time frame and not expecting quick returns, but being there for the long term. But if I recommend that to everyone who doesn't have time, the resources, the passion, like I do, to put the time to learn. But yeah, find a niche that you're interested in, that you believe in. You've done minimum research in it, and then dollar cost average your way in. And then that could be also a timing factor for you as you learn more about it, right? You might start with dollar cost average, you learn more, and then you decided to put more into it because you believe. And then you got to trust your research too, because sometimes you might find something, but your personality might not want to accept it yet, and that could cost you in the long term, because like you don't believe what you're seeing, and that happened to me sometimes too, and I regret it later. So but these things comes with time as you practice with investing. But best way to start, man, it's dollar cost average. It limits your risk, maximize your return, and then it gives you enough time to learn more and still be exposed in the market so that you don't miss on profits. And yeah.
I appreciate it. I appreciate it. So I'm gonna go through the chat real quick, and then we will do our final thoughts. Salute to Natasha Vincent. Salute to Wealth Engineering for letting her know that we're here. Salute to Canada. I see you all are represented here. All right. So Peter Investor M stated that investment return equals math plus psychology. Very true.
It's a beautiful way of putting it. Beautiful way of putting it.
Very true. Let me see.
Shout out to you, Peter Investor, man, and shout out to Natasha Vincent too.
Yeah. Salute, Natasha Vincent for appreciate you subscribing. All right. Let me see. I'm not sure. Mr. Awesome. Excuse me. She was saying hello to Peter Investor Man. Mr. Awesome says that sounds like white privilege. Someone called Pusha T. I'm not sure what he was referring to. Wealth Engineering. I heard Drake was able to get Pusha T banned from Canada, man. I don't know what's up with that. What's up with that?
And I don't know, man. I don't know what's up with Drake, man. I still have a grudge on Drake for destroying modern women in Toronto.
Drake, he's also slaughtering men too. He's
indirectly, man.
Yeah, he's got the whole industry cornered.
Man, ridiculous.
All right. As first, Jed, letting Peter Investor and know about BTB's networking. Let me see. All right. Let me see. He says, yeah, it's like a bust down. You're talking. Keep your feelings out of it. There was in your best interest. Always have an exit plan. Okay, Mr. Awesome is sitting up there saying that I don't know. I thought for a second he was talking about investing, but he might be talking about some young ladies or something.
Treat it like a buzz down.
He says, treat it like a bust down. You're talking to. Keep your feelings out of it. Do what's in your best interest, and always listen. He said
he might be talking about exit plan.
That's what he's talking about. He's talking about money.
Exit plan for investing.
He's talking about. He says have no emotions with the
with investing.
Yeah, it's not easy to do. It's easier to said than done, right? Because sometimes you work hard with your money. Many of us in the Black community, we don't necessarily grow up with lots of money, so we're kind of like excited when you do get it, and then you're afraid of losing it and back to where you are. So you have to treat all those bad thoughts out of your mind and be your own psychologist in a way, or to kind of therapist or something in a way to deal with those issues. But over time, man, you have to. But I definitely agree with the idea of having an exit strategy before you get in. I do that for everything. Jobs, I do that for jobs, real estate, anything I do, I have an exit strategy before I come in. It does not mean you have to follow it. It could change, but it's better to have one before when you get in. It gives you a clear picture of which decision you should do along the way based on your strategy that you want to keep. And it's okay if you want to alter that strategy later on based, maybe life happens, maybe you have a different opportunity that happens. So it's okay, but always have an exit strategy before you come in or an investment. And it's a good rule to follow to at least have clarity on what you need to do.
Yeah. So he cleared his point. He was talking about emotional investing, First Gen Corporate, did you have anything that you wanted to say in reference to what we discussed right there about being a contrarian investor?
Yeah, so I definitely believe in that. I remember first hearing about NFTs early last year, and someone was explaining it to me, and the way he was explaining it to me, I had so many questions. I'm like, okay, how do you make money from this thing? What is the return? How is this unique? How am I locking this down? How am I making this exclusive? And I was asking these questions, right? Because I'm thinking it's a traditional investment. I didn't realize at the time that this is an entirely new investment. And then the whole NFT craze just boomed, happened afterwards, and now it bust. So I mean, I'm glad I didn't invest in the NFTs at that time, but more for contrarian investors. When I started hearing, people like especially crypto, like I'm already invested in it for many years now. When I heard people talking about it, I was like, ooh, no more crypto buying for me. I said, I'm just gonna hold the bag I got now and just let it ride to the top, right? I do believe in contrarian investing. I do think you have to go against the grain. That's just my philosophy in life. Like you really do have to be willing to go against the grain. Like you can't be afraid to stand out. You can't be afraid to be bold. You win some, you lose some. That's just a part of life. So I wholeheartedly I agree with contrarian investing. I really do. I think right now, like I said, I just made an investment recently. This was when I was investing in something. It's down like 20%. So I do some cash on it now. I do some more cash on it. I was like, okay, this thing is gonna be down 20%. Let me throw some cash on it. I think it's gonna go down even further. So even to the top rate, dollar cost averaging, I'm sort of dollar cost averaging because it went down 20%. I bought a whole bunch more. I know the bottom is not there yet. Probably go down another 20%. I'm gonna buy a whole bunch more again. So I definitely believe in dollar cost averaging. I believe in contrarian investing. People are scared right now. Listen, I'm sitting on cash. So let me just get this cash out right now. Just do it slowly, just do it responsibly. And I'll be laughing to the bank, 5-10 years from now.
Definitely put those soldiers to work, for real, for real. So yeah, Mr. Austin said that he's seen the Bored Ape Yacht Club all over the internet, So it's definitely some waves that are happening. And I'd like to have a conversation about NFTs because to me, I associate NFTs with what the wealthy people were doing with the art industry, and I feel like it's the same exact thing, but I could be wrong. So I need to look into it a little bit more. So maybe I can have a conversation, or I can bring wealth engineering and PerryUnlikely to really speak to it to see if there is a one-to-one relationship as it was in the past in the art industry. So what we're going to do is we're going to go ahead and do our final thoughts, and so we'll go ahead and wrap up. So PerryUnlikely, do you have any final thoughts in reference to dollar cost averaging, whether it's best at this point to go ahead and dollar cost average our way into our future positions, or should we be focusing on lump investing and taking advantage or looking for the dip or the low positions, or should we be doing a mixture of both? Having dollar cost averaging as our primary play, but having a little stash for us to really go in when we feel like we had a unique point.
Yeah, absolutely. So I think right now, well, first of all, if you don't have no emergency fund, you gotta get an emergency fund. I mean, you gotta get something. You can't be. I mean, to have a bunch of stocks and you can't even fix a tire. I mean, it's a whole nother issue. But let's say you got that covered. I think now's the best time ever to DCA. I think dollar cost average, because with all the I believe even people that study the market hard, there's no perfect way to know how this is going right now because there's just so many factors. It's kind of everything's jumbled up. So, there was the pandemic, the overprinting, just the cycle in general of the real estate cycle is definitely overextended. The crypto cycle, if you want to say traditionally 4-year, although it's lengthening, it's over, you could say that it was overextended or getting there. So we just got so many markets right now that it's kind of hard to tell, the stock market overextended. So with that being said, we just don't know 100% all these issues going on from a technology standpoint, semiconductors and all that, and chips. So because of that, I think the best thing is you dollar cost average until we have more information, really. That's the way I look at it. Now, for those who have the means and the time, if you do see something, that you think is just a killer deal, yeah, throw some extra on it. And then the only other thing I'll add, this is a good time. I mean, I'm speaking from the extent of a married man, but for anyone who just had, a plan down the road, make sure that, or if you do have a significant other period, make sure you take this time that things are down to teach them, if something happens to you, at least, how to get to those assets, what to do. We don't do that a lot. And it's just a loss. I mean, so I got two sons, I'm married, my wife. So it's important that they understand at least how to be able to benefit from those assets should something happen to you. So, and it's a lot easier to teach that in a downtime than when things are rolling and super excited, because you just get so caught in the money making aspect. You don't take the time to do things like that. So that's also important. But yeah, I definitely think dollar cost average, and go ahead and set it up on some of these apps. I even believe for those that do use Coinbase, if it's crypto, I'm pretty sure you can do it on Webull, any of these apps. Set a certain amount, whether it doesn't matter if it's a week, day, week, month. Go ahead and set it up and just let it continue at that steady pace. And, it has proven that those who dollar cost average, have done well, have really done well. And I would tell you, anyone who's dollar cost average for the most part in crypto, even if you did it in Bitcoin over the past, 3-4 years, you're still up. So it's still, even in a down market, you're up. So I think that's all I got.
You want to go answer this real quick, Perry?
Yeah.
So we can go ahead and just wrap up with answering this question right here. So Mr. Awesome is asking, what do you feel like constitutes an emergency fund? Do you believe that it's just cash or money that's in savings, or do you think that it's something that's invested in a brokerage fund where you need about 7 days in order for you to access the funds? What do you believe constitutes an emergency fund?
So I really think it's and I've thought it was important to have an emergency fund long before I was in crypto, but I think it's really in a savings account. If it's going to be in any market at all, maybe a money market. I mean, it needs to be something real easy to get to. It can be in crypto as far as I'm concerned, but it just needs to be like stable coins, which at that point is really no different. Not in actual, you don't need to have it in the actual cryptocurrency that fluctuates. It needs to be straight up. And yeah, that's the only place really where I like a savings. And me personally, they say 3 to 6 months. I like 6 months. I mean, if you can't do 6 months, obviously go 3. But, with Dave Ramsey, there's the theory that you got an $1,000 emergency fund. Then separate, you've got your 3 to 6 months. To me, I just put it all together. If I got $1,000, if I have 6 months worth, then I got $1,000. So I just kind of put it together. But I'm thinking more savings. But if you want to go beyond a savings account, at least some account that it's really, I don't even necessarily think you want to take a week to have to get to it. That's just my opinion though.
Right.
Let me,
generic. Yeah, go ahead.
I'll have to drop, but I just wanted to chime in very quickly on the 2 points about DCA and this question.
Sure.
So for this question, I like what you said, Perry. I agree with you. The first goal is to save $1,000, because regardless of how low this amount you think it is, there's so many people that, especially millennials in my country, Canada, the millennials, 70% of them, they don't even have $1,000 saved, because you're living paycheck to paycheck. Well, you're not going to have $1,000 saved in your accounts, right? So first goal is get $1,000 cash in your saving account that you can access at any time to help you with some problems. If your car breaks down, you have $1,000 cash, right? If your mom kicks you out of your house, you have $1,000 cash that you can go to a motel or something and survive and get your thoughts across, right? So that's the first priority of a emergency fund. Next, when you do get the $1,000, try to graduate to 3 months. So that means, and by 3 months, I mean assuming that you have no income, you lose your jobs, you have no one to help you out, can you pay all your bills for the next 3 months? If you can do that, then you'll also get to another level of the society where we're talking about less than 10% of people in any North American country, let alone the world, that has about 3 months savings they can access at any time to help pay all their expenses and maintain their living lifestyle. If you can maintain your lifestyle with 3 months savings, then that's the second phase, and you graduated, and man, you are, a good spot. And then after the 3 months, graduate to 6 months, right? 6 months of cash you can access at any time to depend to help you out, and you can pay your living expenses and maintain your current lifestyle. If you could do that for 6 months, then you are the good idea. Now, depending on your personality, some people are super conservative, super risk adverse, like they cannot handle a lot of risk. So you might want to do a year, but usually 6 months is a good way to do it. And after that, the discipline that you have developed to save that money, I want you to keep that same discipline, but instead of putting it on the saving account, now you're going to put it on the market, whether it's a saving account for real estate, whether it's stocks, whether it's crypto, whether it's your own business you want to do on the side, whatever it is. If you're good, you go into research the market to see which one is the best market you should go first. But if you could get to that point, at least you could allow yourself to take that limit, that risk, because you have a good cushion to rely on if things happen. Currently, actually, right now, I'm taking some of my really emergency fund because I just 2 weeks ago we decided to move into a new place. Like I'm moving to a new place, so I'm taking some of my emergency fund to set the place up. If I didn't have that, then I would have been sleeping on the floor, basically, or even not even have enough money to pay the first and last month, which is they basically not able to secure a great location because at this time of the year, everyone is looking for real estate to rent, new rent. So I would have lost that property. I wouldn't be able to secure it. So that's what I'm doing right now. In thanks to my emergency fund, I was able to secure a good place. I have a beautiful gym on the basement, right? Very close to work, very close to my family. I love it. But takes to my emergency fund. But what am I going to do next? Now, the money that I took out, I need to refund it back in. So I need to start doing the same discipline again and to put that money back in so that it could be 6 months again. But then once you do that, you go find other investments type. And then if you don't have enough time to do the research, we're talking about contrarian methods. We talk about a lot of investing style today. But if you don't have the time to do all that, definitely try to approach the market like SPY, for example, or some ETF, some index that covers a large portion, a large basket of a lot of different things all at once. You invest in that, you do the DCA, dollar cost average, let's say $100 a week, every week. And then until you do your research, maybe while you do your research, you might realize, you know what, I'm the gold type. I like gold stocks. I'm going to focus on that. Or I like technology stocks. I'm going to focus on that. We talk about AI, cloud computing. We talk about augmented reality. These are a niche that I'm focusing on right now. We talk about overseas. If this is something that you want to look into, Taiwan, for example, again, Taiwan, look into that. So if these are things that you want to look into, you could slowly dollar cost average your way in as you learn more. And when you learn more, you're going to have knowledge, confidence to invest more, to risk more, because you're going to be backing that investment with your research. That's what's going to give you the research. And if you don't have that yet, at least you still in the market by dollar cost average. You limit your risk. You still over maximize your time, your profit over time. And over a long period of time, your average cost is still low. And then you expose yourself to some good potential to make a high return on your investment. So you follow these rules. Again, it's not financial advice. I'm not a financial advisor. This is things that I do personally. This is how I was able to at least build the foundation for me to do certain things in my life, like taking bigger risk to make potentially, like I was able to make 8 of my position last year at least 10x, and then 2 of them One of them did 54x. Another then it was some, I forgot the X number, but it was way more than 10x. So I was able to make those investments. Why? Because since 2017, 18, I was making some certain moves to be able to allow myself to save enough money to have the capital to make those moves, right? If I didn't start on the right step, I wouldn't be able to do that. It takes times, but if you can do it, it starts yesterday. If you didn't start yesterday, you start today. So that's again, it all depends on you, your personality. But I did, and that's what I did, and that's basically what I try to motivate people to do on my channel too. So but with that said, that's what I wanted to say. And but I love dollar cost average. It's definitely a nice way, and I agree with PerryUnlikely too. If there was one time, if there was one time to dollar cost average, it's definitely now. Why? Because there's a lot of uncertainty. The market can move. You don't know which investment to do yet. Maybe it might correct itself. Who knows? At least you're still in. You're still exposed and you're not too exposed because you're controlling it drip by drip. And that's just a good way to approach the market over a long period of time. You're still going to be ahead.
Salute. Well, thank you for joining us, Wealth Engineering, man. I appreciate you. I know you have to drop, but thank you for sharing that valuable information, and you just spoke to your account. You're not sharing any investing advice. You just really just gave us an account of what you did in order for you to be in the position that you're in, man. Thanks again. Subscribe to his channel. Subscribe to PerryUnlikely's channel. Subscribe to Wealth Engineering's channel. And there's valuable information that they're both sharing. And, this is a part of the conversation that people in the past thought that we couldn't have. We were not capable of having. And so I appreciate you all for joining us. And so I'm going to go ahead and go to First Gen Corporate. I know you need to drop Wealth Engineering. Salute, bro. And have a good night. So what Wealth Engineering, do you have any final thoughts for us in reference to what we've discussed today as it pertains to dollar cost averaging and any other final thoughts that you'd like to share with the people?
Yes, as Wealth Engineering, I would like to answer this question. I got you, Cynthia. I kind of want to answer Mr. Awesome question because I agree with the dollar calls.
Oh, my bad. I actually wanted to also ask you to speak to the to this question as well.
Yeah, and I was just joking with you, Cynthia. I would say the dollar cost averaging is very important. Like Perry, like he said, there's literature out there that suggests that if you dollar cost average and ignore the hoopla that's going on, then you're still going to end up ahead over time. And again, is not necessarily timing the market, is timing the market. That's some investors' approach. To answer Mr. Awesome questions, as an emergency fund for me, I think a year is a gold standard. Like I personally have a year. Again, that's the type of industry I work in, and I really do like to have a peace of mind when I go to sleep. I would say for emergency fund, there's 3 lines of defenses. I would say the first one, and again, this is not financial advice. This is informational, entertainment purposes only. Please go seek, your respective advisors before you make any decisions. I would say the first line of defense is a credit card with a high credit limit because essentially it's a free 30-day loan for an emergency fund. And then on top of that, I would layer with a basic savings account, no fees at all. Try to put at least 6 months of savings or expenses in there. And then after that, I will put the third line of defense as a boring index fund. Index fund like a VNQ, right? Like that's a REIT, a QQQ, a total stock international blend. Essentially, what you're trying to do with this index fund, you're not trying to get S&P 500 returns. You're trying to get a deviation lower. So instead of trying to get like, I don't know, 9-10%, you're really gunning for 5 to 6%. So the volatility is going to be way more reduced. Your money will go up over time. It's going to beat any local bank that you may have. Just keep in mind, when you have in a brokerage account, it takes 2 days to settle your money. So that's important.
And then it's 2 days to settle. Is it 7 days for you to get access to it?
No, so I know when I transfer money in my brokerage account, ACS transfer, it takes 2 business days.
No. I'm talking about when you sell your position.
When you sell your position, depending on your brokerage, depending on the type of relationship, 2 to 3 days for after you sell it for that money to settle, then you have to transfer. I mean, yeah, you gotta be careful with that. Again, if you have better relationships, meaning you have more money with your brokerage account, you can call special favors in.
All right. So I appreciate you all, like I said, joining us in this conversation. Like, this is very important right here. I don't think it's ever been as important as it is right now for people to understand dollar cost averaging, to understand the value of, if you don't know where to start with the ETFs, start with something that's palatable. And there's something in your brain called the reticular activating system. And what it does is it manages relationships, and it manages the relationships that we have to things, concepts, or ideas, so to speak, right? And so if you have an opportunity to look at an ETF that's exposing you to the total stock market, VTI, right? Or a VOO that exposes you to the S&P 500, what you're going to start to notice is you're going to start to, what I recommend you do is, this is not investing advice, but what I suggest that you do is you look at a fund, an ETF, like a VTI or VOO, and start researching the terms that are on their brokerage page or on the respective ETF's page. And you start to understand what an expense ratio is, start to understand what the returns are, start to invest some time into understanding that, like, 1 year returns are not even a practical snapshot of what these funds are doing, that you need to go as far back as possible in order for you to see the historical impacts or the historical trajectory of these respective funds. It's really important that we have an opportunity to be able to identify these things in these ETFs prior to us having conversations about anything in the brokerage space or like in the retail space as far as individual stocks and shares. This is where conversation starts, in the ETF space, mutual fund space, and then you can go start talking about individual stocks and individual companies. But I appreciate you all for joining us. Definitely take out the time to figure out how you could position yourself to dollar cost average going into the future. And hope you all have a great night. Thank you for joining us. All right. Peace.